welcome you all to our first annual Axios BFD. And for those of you who don't know what BFD means, at Axios, it's what we use to describe something that's, well, a big deal. And today you're going to hear from some of the best business people in the world and also leaders in the deal-making space. And for us, we're using this event to showcase the content that we have in the Axios Pro newsletters and also the Axios Business Suite. And we hope that you'll continue the conversation with us on Twitter at #AxiosBFD. Jim?
Welcome to Primac Palooza. Any opportunity to get Primac groupies in one room is a big frickin' deal to me and to us. So thank you for joining. To those of you that are pro rata subscribers, thank you. To those that are pro subscribers, thank you. To those that are thinking about being pro subscribers, what the hell are you waiting for? Get on that. This would not be possible, both like this cool setting, the meetings earlier, apparently the late night happy hour that everyone had yesterday, if it weren't for our sponsors, JP Morgan, Latham & Watkins, and West Monroe. So thank you to everyone for making it possible. CSL is our production partner. And then our events team. Like, these things are hard to pull off. So hopefully you're going to have an electrifying day of cool interviews with people you know, people who make news. So have fun. Stick around at lunch. We're going to have some pop-up conversations, including with the CEO of Neiman Marcus. So enjoy yourself. Give us feedback on how to make this even better next time. But this is an annual event for us, and it's a BFD. So thank you.
Thank you, everyone, for coming. Thank you, everyone, for standing. This is a great turnout. We've been working on this for months. I am psyched to see everybody here. So let's kick this thing off. Our first session this morning, our first guests are kind of a power duo in the worlds of sports and entertainment. They will be the ones bringing back the XFL in February of next year. Please welcome Danny Garcia and Jerry Cardinale.
Good morning, everyone.
So for those who don't know, so Danny is co-owner. She is chair of the XFL. She is also a film and television producer. Jerry is founder, chief investment officer, I think technically also, managing partner of Redbird Capital Partners, which has probably bought a piece of your favorite pro sports team. So Danny, let me start with you. The XFL has this interesting history. Its first season, it lasts one season. Its second season, the pandemic cuts that season short, and then it files for bankruptcy. What made you look at it and say, yeah, want to buy that?
You know, I actually have a long history with the XFL. So I was around in that first iteration, which was a little bit crazy, a little bit anti-NFL. And the second iteration, I felt, wow, this has hit the sweet spot. I'm like, this is extending the football proposition. It's in spring. These athletes are playing with chips on their shoulders, and the product that we saw on television was excellent. So in my mind, as I was looking at this, first of all, I had wanted to be a part of that. So unfortunately, when it did go into bankruptcy, it was an incredible opportunity. But for myself, I saw an opportunity to take this football universe and wrap it around with layered storytelling, bring it closer to the audience, invest in the athletes even more, bring more technology, and make a property and extend it as if it was a live IP. And when I called my partner, Dwayne Johnson, I said, hey, I want to buy the XFL. This is a crazy idea, but let me tell you why everything we've done in our life has led to this moment. He said, absolutely.
Said absolutely. Jerry, how do you get involved in this? How does Redbird get involved in this?
We were looking at it independently, and you know, I was originally looking at it and consulting with the NFL, with Fox, and thinking through whether or not there was any real binary risk to this. You know, is there a legitimate demand in the marketplace for spring football? And that initial work that we did really convinced me that there is an interest
Okay,
and
what
demand.
convinced you there was a demand for spring football? Because we know not just the XFL, but there was was it the AAF and obviously there's the USFL, which still exists in its new formation. What convinced you there was a demand for spring football?
Look, I mean, football is one of our greatest exports as a country. The Super Bowl ends the season in February. People in that period, in the spring, from February to May, people would still like to have NFL quality football. People today also want sports to be entertaining. And, I've been fascinated with, all the investing that we do. The sort of next frontier potentially is investing in leagues. I look at these leagues and I say, my God, that's a great aggregation of entertainment properties and IP. At the end of the day, what really convinced me on this was when I got the call from Danny and Dwayne. And we
Did
said,
you know them? What was the relationship? Or Danny, how does that happen?
Well,
Why does that happen?
We were, like Jerry, we were all assessing the property and thinking about who were the best in-class partners we could actually have the opportunity to work with. And the name, Jerry Cardinal and Redbird Capital, kept coming up, and it was shared that he also had an interest. So we did a mutual outreach to see, what is this and how are we thinking and are we like-minded? And it was fantastic.
So, Danny, I think you said this on ESPN, something I watched with you and Dwayne,
Yeah.
did an interview, and you said that it's about, quote, everything around the ball and amplifying it.
Right.
What does that mean? I mean, does that mean a continuation of what we saw in the XFL before? No extra points, faster play clock, in-game interviews? Or what practically is somebody going to see in February they've maybe not seen before?
Well, they are going to see the best practices, right? Faster game clock, rules that make sense, dynamic plays that matter. So, in addition to that, we're looking at innovation as far as what happens before our players even get on the field. How are you introduced and how are you experiencing that? We'll have game activations. We have partnerships coming on so that you're not just watching it, but you're experiencing it, you're feeling the culture. And to continue with that, we have storytelling that's 365 days out of the year. So there's an additional element that we get to do because we own the league. We get to control the culture.
Okay.
We get to be very, very agile.
And before I do this, I'm just going to tell them backstage, I don't have a clock. I should probably have a clock. It's around that. You do own the league, right? And it's been this kind of, there's kind of two ways that pro sports work, right? You have the franchise model, which how the NFL does it, how most European soccer does it, and then you have the own the league, kind of call it the UFC model, which you're following. Why the decision to not try to franchise out the teams?
look, I think we haven't made that decision. I think in the beginning to launch this, where what we have to step back and say, well, what are we trying to do here? What we're not trying to do is practice Einstein's definition of insanity, where people have tried this before, and I think where we are diverging from what has been tried before is that we're not looking to create a competitor to the NFL. We actually have a great partnership with the NFL.
Is that because no one can? In other words, does the NFL the NFL
there's
be competed with?
I go back to my fundamental question: is there a legitimate need in the marketplace for this? There is no legitimate need in the marketplace to compete with the NFL. The NFL is the dean of football.
It's a monopoly.
It's incumbent.
Is it a
upon-
monopoly?
Is it a monopoly?
Yeah.
Well, I know that's a bad word, but there's a pejorative connotation to that. I would say let me just say there's no need for a second NFL. However, there is a need for a development organization for the NFL on player development. One of the things that I learned is there are 53 players on an NFL team. 53 to 75 could have easily made an NFL team. There's just only 53 slots. So you ask yourself, is there a value proposition we can actually put an NFL quality product on the field, but make it more entertaining? And you have the two best people in the world. If you want to create a live event entertainment company rooted in legitimate football, this is how you do it.
Danny, let me ask one other franchise question. One of the big differences between this XFL and its prior iterations, no team in LA, no team here in New York. Those are two, and to be honest, no team in the four biggest TV markets in the country, because none in Philly or Chicago either. Why?
We were very specific when we were doing our analysis of where our teams and where our teams would be as far as the cities. So our XFL teams are very, very tied to their communities and tied to football-heavy, football ethos cities where we can thrive, because we knew we were bringing the fans back to the game. So for our analysis, it made tremendous sense to do the locations that we have now, because these larger markets can always be in the future.
There is an elephant or a rock not in the room today. How important is, let's just say, kind of his celebrity status from your perspective to getting, as you said, you talk about the fans, you got to get them in the door the first time, whether that's physically in the stadium or turning on the TV. How important do you feel he is going to be to at least the initial success of the league?
Well, DJ is a force, hands down. I mean, he's an incredible, incredible partner. I would answer that by saying the metrics, the proposition, the business plan that has created the success of Dwayne Johnson is the business plan that Dwayne and I have created and will live within the XFL.
What does that mean? How would you kind
so
of
I would
catalog
say
that?
the elements that have led to this 450 million followers all over the world, that's the value proposition that we're bringing. Now, Dwayne is deeply involved and super passionate about the XFL. As Jerry had mentioned, he sees himself as player 54, that player who didn't have a chance, even though his plan B turned out very, very well. We don't complain about that. But his involvement as an owner, as a founder, has been invaluable. And the athletes and the audience relates to what he's saying. They see the authenticity. So he's extremely important.
Jerry, you referred to the fact that there is a player development partnership with the NFL as a piece of this. Should folks view the XFL as pro football's minor league?
Look, I mean, there's definitely the potential for that element. One of the two key pieces that Dwayne, Danny, and I have put together in this first reincarnation is a great broadcasting partnership with ESPN and Disney. And a real relationship with the NFL. And I think that relationship with the NFL will touch on player development. The NFL doesn't have a G League, if you will. I think COVID actually woke everybody up that, if half your offensive line is out with COVID, you don't have a minor leagues to go pull guys up on. And and if you subscribe to what I said about 53 to 75 all being great NFL quality players coming out of college and wanting the opportunity to develop themselves further to make a team, this is a great strategic relationship. Then there's health and safety initiatives for the players, and then there's rules innovation. I mean, the NFL, the NFL is a juggernaut, but they are always looking to make the game more entertaining, and who better to consult with than Dwayne and Danny on that?
For players 54 through 75, as you say, I would think some of them coming out of college obviously want the opportunity, as you say. They might also look at past alternative football leagues, particularly the AAF, which kind of seemed to literally strand people in hotel rooms all over the country and told them find your own way home. How do you convince them that there's going to be enough viability to this, that they should not look for another job, another career, something else, and take a shot at this and not be worried that this is going to last 3 months and then they're going to be on the street?
Well, we have transparency of ownership. We're very transparent about what our intention is, how the league is being run. You have to look at the credibility we have of the executives, our football ops programs, who are leading these teams, our coaches, and then quite simply, the conversation of who's owning this. Redbird Capital, Dwayne, myself, the fact that we are there, we are public, what's our intention. So we actually do very, very well in extending these relationships and sharing the authenticity and our commitment to this league.
Jerry, expanding off from the XFL a little bit, the first time I ever heard of you was kind of when you helped when you were at Goldman and you helped basically create the Yes Network through that deal with the Yankees. And then obviously you end up forming Redbird, which is a private equity firm that invests in a lot of different things, but a lot of professional sports things. Did you expect, even when you formed Redbird, that there would be a time when private equity funds themselves would actually be buying ownership stakes of pro sports teams, existing pro sports teams?
A great question. I mean, it's a great question if you look at this current moment that we're in, and the whole supply-demand imbalance of this kind of capital, institutionally formed capital, chasing sports as an asset class. When we did Yes back in 2001, we signed that deal the day before 9/11. Nobody knew what sports was, and we had to get on the air in April. That was a game changer. It was a game changer for me personally, but it was a game changer in the industry because never had real scaled institutional capital partnered with rights holders to monetize intellectual property. Well, that was back in 2001. That model has not changed. That is exactly what Dwayne and Danny are doing. The thing I'm fascinated by is you can Venn diagram us and the guys like us and the way we invest and love to build companies and operationalize IP with Danny Garcia and Dwayne Johnson, and then you add ESPN and Disney, and you add a real partnership with the NFL. If we are doing our job and you look at where sports is today, guys like us should be catalysts for evolution. You can't just sit there and just expect things to keep showing up. I mean, we're in a mentality right now in sports where everybody just expects things to keep going up linearly. I think people like
Will
us.
they not? Will they not? Because that is the perception, at least when it comes to call it the big four sports leagues and even European soccer teams, that in general, people always say, wow, they overpaid for that team. But don't worry, wait 5 years.
Yeah.
It's going to look like a bargain. Do you think, is there a plateau to that?
That's why, come back to your question, that's why you see all this private equity money chasing sports, because there's a lot of facile commentary out there that sports, it always goes up, it's non-correlated to the market. If you benchmark sports asset valuations with the S&P, it's very attractive. There's elements to that that's right, but when have you ever, when you've heard that commentary in the past, it doesn't end well, does it? And so,
But in sports, it has ended well. Everyone, it's always ended well.
Until it doesn't. No, I'm not saying it's not going to end well. It's still, in a world where technology is disintermediating media consumption, there is no better must-carry content, regionally or nationally or globally, than sports. There's no doubt about it.
Danny, let me ask you, when he talked about the media content, we'll have James Pitaro, the chair of ESPN, or president of ESPN, here later today. Sarah Fisher will interview him. You obviously have been involved in a lot of parts of entertainment in terms of television and streaming and films. You're a producer on Black Adam, which I am told came out last week. What have you so far learned, if anything, about the difference between getting a sports league and a broadcasting both deal and all the preparation for a sports league as compared to, call it, a more traditional entertainment product?
And I've actually focused more on the similarities than the differences. So one of the best practices on the entertainment side, and specifically for my production company and my films, is that we are rooted in audience first. And that discipline in entertainment and storytelling has given us an incredible advantage to be in a position where when we're looking at studios or we're looking at partnerships, they can see the return of investment we provide, specifically because we are audience first. It's that element that actually ties in perfectly to sports, and that happens to be the biggest risk with sports. When you have ownership that is not thinking of the property and saying, how is the consumer, how is the fan, how is the athlete also as the audience participating in this? Because we have deep-rooted storytelling and we have those skills, and I will say, knock on wood, we've been very grateful to do it very well, Black Adam release. It makes us extremely comfortable in this market and excited to bring this skill set to sports.
Jerry, you mentioned the evolution of financing going into pro sports. One league that has not evolved when it comes to this is the NFL. You still have to be an individual to own a team. Funds cannot. Is that going to change? Are investment funds of some sort at some point going to be able to buy pieces of an NFL team?
Look, I think the NFL is in a class by itself. It doesn't have to. And I'm not sure the other leagues have to, but the other leagues are in a slightly different position than the NFL. I mean, the economics around the NFL are of such a nature that, the opportunity to buy an NFL team is so limited that I think it's fine. I don't think you need to see the rules necessarily change. And they're not going to have their hands forced to change the rules. What's more interesting, though, is as you see generational changeover in ownership. I've always said that I think these sports properties, these teams are mini Disneys, and I think as we go into a world where technology is constantly pushing the envelope and changing the way consumers want to consume and can consume content, there is a role for institutionally formed capital with the breadth of experience that guys like us have in sports to partner with them, right? And so it's less about the values that pushing the values up. It's much more about evolution and can we be good partners to
Can I ask a quick follow-up to that? How do you think, and this is both kind of in current day and in the future, how do you think the involvement of private equity investment funds in pro sports teams has, if at all, affected the on-field product? I mean, for the end users, which I guess me.
Look, you have to look at, the really interesting, case study to that question is European football, right? European football, there are no barriers to entry.
And you guys bought AC Milan, right?
We bought AC Milan. We're in Liverpool. We own Toulouse. So we've done a deep dive on that. And there's no the barrier to institutional capital. There are no ownership restrictions, but you do have the transfer market and you have relegation. And so what's happening is you're starting to see. Everybody now uses data, right? And data analytics has become a big thing in terms of your question on-field performance. And we are looking to continuously push the envelope in terms of the application of data combined with scouting to improve on-the-field performance. What's the definition of improving on-field performance? Well, is you provide a consistently winning product. You don't have to win a Champions League or a World Series every year. You got to provide the value proposition is providing a consistently winning product. And in order to do that holistically, if you're not going to deficit finance it with a finite amount of capital, it's to drive a dollar of cash flow off of a dollar of revenue. And what's fascinating in sports today, which everyone should pay attention to, is things tend to continue to be done on a multiple of revenue. And one of the things we set as a challenge to ourselves as we look at these properties is, well, why isn't it a multiple of cash flow? Why is this industry any different than the other industries that are valued off of those metrics? And I think that's our goal. I think the value proposition in sports, at least for guys like us and partnering with people like Danny and Dwayne, is, can we take off the field performance, drive a dollar of cash flow off a dollar of revenue, and then put that back into a winning team?
We have 2 minutes left, so I want to change topics a little bit. Danny, let me start with this. Black Adam does come out last week. Did you, and when I say you and DJ Morrow, did you just save the DECU?
Did we what?
Did you just save it?
Oh, that's a triggering question. Did we save DC? I would like to say we kicked open some doors that maybe DC wasn't able to walk through before. So I wouldn't say we saved it. I would say we've added some value. We've proven some very important audience metrics as far as diversity, not only on screen, but as far as the consumers coming to see the movies, and I think we did great work for them.
Can I ask a broader question, which is, so obviously that's a box office success. That's not a stream. You can't stream it. You actually have to go to a theater. You have to watch it on a big screen. Your production company has worked, I think you guys worked on Red Notice, right? So you've worked on some very big budget streaming films. From your perspective, and self-interested I think is going to be different, but does it still make sense for whether it be Netflix or Hulu or Amazon to spend enormous money on streaming-only movies as opposed to just putting them in the theaters?
I think, well, that's a great question. It's also being looked at because you're looking to see how much spend is actually translating to, subscribers, right? So that's, and even success for us when we're with Netflix or our movie now that we're doing with Amazon, it's that end user that measures our success in our back end. I think the combination of understanding that people want to go to the theaters, that is still an experience, and building a combined execution, that's what I think people are really looking at in a real way. It's still a huge box office for us globally. You can't ignore that market. So finding a process that combines both is very important.
And I have 30 seconds, so Jerry, this will be a quick question to you. I'm a fan of the Boston Red Sox. You own a piece of the Boston Red Sox. They finished in last place again, behind the Baltimore Orioles. What the hell?
That's the beauty of sports, right? I mean, you look at how competitive they've been, and then one year, they're
Are they going to
in last
re-sign
place.
Xander? Are you going to re-sign Xander?
We're looking at it.
Looking at.
I'm still focused on the Yankees at this point. I'm still trying to get over that.
I will say we were supposed to have an Axios business dinner tonight or drinks later tonight, and it was rescheduled to a sports bar so members of our team could watch the Yankees game. So have fun with that, guys. Jerry, Danny, thank you very much.
Thank you. Thanks so much, guys.
Hello, everyone. Good morning. It is so wonderful to see so many people here for our inaugural BFD event. I want to encourage folks who are standing in the back to make some space here with us. Get cozier, get comfy. We've got a couple more hours of amazing conversations, so if you are standing in the back, if you want to finish up your drinks, you can please come closer to the stage. Promise I won't bite too much. Well, thank you all for tuning on the live stream and being here in the room. My next guest, she sits at the core of capital markets. She's the president of the New York Stock Exchange, and I'm so pleased to welcome Lynn Martin to the stage. Lynn, I want to first start off by congratulating you. You're coming up to the one-year anniversary of being at the head of the New York Stock Exchange. What surprised you the most over the past year? You know, we've talked at the beginning of the year, and things are a bit different.
What a year it's been, right? I mean, what a year for global markets in general, not just in equities. I like to say, you know, I entered the job, didn't really realizing that we would have a war in my first couple of months to deal with, all the volatility in the market. But I think today actually speaks to the thing that has been the most pleasant surprise throughout this all, which is the fact that people really want to convene. They want to be in person. And the way we think about product development, the way we think about service development is to convene with our customers, to be very in front of our customers, to have conversations with our customers, particularly now more than ever, given all the economic uncertainty that exists in the global markets, given all of the different focus that CEOs on our issuer community and our trading participants have about, okay, how long is this going to be? When's this going to end? What's your forecast? So many questions, and then you layer on the fact that CEOs more than ever are looking to do the right things in the market, embed ESG, deal with the investors that they have in their stock at the moment. So I'm thrilled, pleasantly surprised, as I said earlier, the fact that people want to convene, people want to have conversations. And you know, we've been very deliberate in the fact that we want to be in front of customers. We want to be public facing at the moment. I think we have a very important role to play to be a very public-facing organization, particularly at times like this, where there's both economic and geopolitical uncertainty.
And you talked about just now that you're having these conversations. That question,
yeah.
How long will this period of uncertainty, muddiness last? What's your best guess? When Jamie Dimon comes out here and says, you know, we're going to have a recession, this is the percentage chance that we're going to have one, and Jeff Bezos tweeting, I mean, who should we be listening to at this moment?
I don't know who we should be listening to. And I wish I had the crystal ball, and I wish I could come up here and say, oh, it's going to end on this random Tuesday in this random month. I don't have that answer. And what you're seeing in the market is just a lot of uncertainty. They don't know how long the Fed's going to go in terms of interest rates. They don't know how severe it's going to be. But if you look at various other aspects of the underlying economy, there is reason for optimism. Strong dollar, strong US dollar, that's one reason. The unemployment rate, despite the fact that that's part of what's driving the Fed at the moment, unemployment's still at a record low. So that means people are actually earning wages. So they do have money to spend, although wage inflation is part of the challenge. So it's a really complicated question. And I'm hopeful that folks in DC are very prudent about the steps that they ultimately take to get inflation in check while at the same time continue to preserve transparency, liquidity, all those sorts of things in markets.
And when you think about that, do you feel like there is a stability, at least in the consumers' minds? Even though sentiment is down, we still see decent spending. I mean, the downturn has been in tech stocks, higher risk, right, equities. So there does seem to be pockets of strength. Where would you say?
Yeah, I mean, I think you just look at the way you're spending your money. There was the revenge vacations that we all took after being cooped up for so long. There are all these types of amazing events that are happening where we're convening business leaders, political leaders in person to have conversation. So clearly the travel industry Don't know if any of you had trouble getting flights here, but it's challenging to book a flight at the moment. The travel industry is doing really, really well. That doesn't mean that people are going to not buy that new pair of shoes, buy that new outfit, whatever the case may be on the consumer side of the business. You're just going to have to balance it with the fact that the price for goods are going up.
Is this the new normal that we're seeing, the volatility that is back? Is this what we should be expecting since the pandemic was really an anomaly?
Yeah, that's a good question. I don't think this is the new normal. I think it's going to be the normal until the Fed gives a clear sign that the end is near and starts to take more deliberate steps to stop raising interest rates 75 basis points. The inflation print a couple of weeks ago, I gotta say, it confused me. It confused a lot of people in the markets, mainly because inflation, 8.2%, markets opened down 500, 600 points, but then they had a strong rebound at 900 points. Stuff like that is honestly what is confusing consumers. It's what's confusing retail in the markets, what's confusing the institutional investors. It's also what's slowing down the IPOs coming to market.
When we chatted in April in DC, you mentioned there was a backlog of deals.
Still is.
At the moment, we're still, though, seeing the lowest levels of IPO activity in the US in 20 years.
Yep.
What are they waiting for? How can they get prepared for the timing to be right again?
The VIX being at 30, volatility index being at 30 is not good for IPOs. It's just the way it is. When it gets up to that above 20, really the upper 20s, which is what you see, even if it's not 30, some days it's 35, some days it's 28. It's kind of a signal that the market's not yet ready for the flood of IPOs, the IPOs that are really in our backlog to come to market. That said, we did actually execute the largest IPO of the year on September 15th of this year, where we saw a really strong business, really strong cash generator, really strong profits, Corebridge, come to market. It priced within its range, raised $1.7 billion on its IPO day, and is trading above its IPO price in the market. So that's proving, to me at least, that the market still will consume companies that are high quality, solid businesses that are ready to go to market. So we were really happy, to see the results of that IPO and the continued results of that.
And it's a tough year to compare, right?
It's
so
a really tough
two record
year.
years in 2020 and 2021 with IPOs. So I think something that companies keep in mind, right, as they report, let's do a 2-year comp.
Absolutely.
You mentioned some of the other issues that companies are thinking about. ESG is in focus. There is some backlash now against ESG investing, against that word and the term and sort of the philosophy of it. What are you hearing in the rooms that you're in about this particular issue?
Yeah, so I like to say ESG is a market. There's a buy and a sell. Everything's a market, there's a buy and a sell. People have different views. That's what ultimately makes a market. Ultimately, from the CEOs that I'm talking to, the 2,400 companies that we have listed on the stock exchange, which represents more than $30 trillion in market cap, they are looking to embed elements of environmental, social, and governance responsibility into their day-to-day. I don't think anyone can argue the positive effects that, for example, diversity and including additional diversity has had on business. So I don't really think that's up for debate, and that's something that we spend a lot of time with our issuers and with our customers, providing solutions, providing tools for them to further enable diversity. Environmental is a bit stickier only because some of the disclosures are not yet ready to be measured accurately and disclosed accurately. Specifically, something like a Scope 3 emissions target. Scope 3, for those of you who don't follow this in as much detail, is your full supply chain, the environmental impact of your full supply chain. In order to accurately disclose that, you need to have all of your suppliers accurately disclose that. And that's something that's really challenging for some businesses. So it's not that CEOs are not looking to disclose additional information and then let the market decide whether it's valuable or not valuable. It's more that they're trying to figure out how to accurately disclose those sorts of metrics in the market.
From a visibility perspective, though, has there been increased nervousness around marketing a company or a set of investments as being focused on ESG because now we're seeing bills introduced on Capitol Hill, we're seeing state legislatures banning investments. So is that something that you're sensing?
You know, we still see about 40% of money coming into ESG funds, but when you're actually investing in a fund, funds are very public with what their prospectus is, with what their investment strategy is. Think about it in very simplistic form. An equity ETF, for example, that's benchmarked against the S&P 500. That's pretty simplistic. It's benchmarked against the S&P 500. But more and more funds will, embed a ESG filter, be it one that's got more focus on carbon neutrality, net zero, diversity, whatever the case may be. That is all has to be publicly disclosed because all of those funds follow IOSCO principles, which are best in class principles. So it's really comes back to people having to do their homework about what they're investing in, whether they want an ESG flavor with a certain lens, environmental, social, or governance, or if they want just your standard S&P 500.
Do you think the label is too widely used?
I think the label may have been too widely used, but it's getting more refined. So carbon is a big area, carbon neutrality. People are starting to zero in on the different elements of ESG. It's funny because for many years people talked about ESG like it was this one thing when it's really not. Environmental even has multiple lenses on it. Social has multiple lenses on it. Are you looking to do good outward facing, or are you looking to be a responsible employer and invest in your human capital that you have on your payroll? Governance is probably the easiest one that has for many years had really good disclosures in terms of diversity of boards, diversity of leadership teams, those sorts of things. But for a long time, for whatever reason, the diversity thing got put alongside the carbon item. So there are two very different investing strategies.
So you're expecting the E's to be talked about separately from the S's to be G's.
And by the way, I think that's a good thing, ultimately, because it then comes down to giving more specificity to investors, giving more specificity to the market as to performance in any one of those lenses.
And then more measurable on an individual level.
Exactly.
Another sort of squishy idea, stakeholder capitalism. Sounds great, feels good to say. What does it actually mean?
It's a good question. I think actually if you ask many CEOs, you'll probably get 15 different answers. So that's another topic.
How do you define them?
Stakeholder capitalism could, in my mind, there are multiple stakeholders when you're running a business. There are the internal stakeholders, there is your board, there is, if you're a public company, clearly your shareholders. So ultimately, CEO's responsibility, a public company CEO's responsibility is to deliver returns to its shareholder, but to do so in a responsible fashion.
Now, when we talk about, marketing companies to public, I miss being on the floor of the stock exchange IPO day. I mean, it's a wonderful experience and it's very exciting. But I'm wondering now with retail investors driving news cycles and obviously the markets, how has that changed when a company decides to go public?
So I think that fact that there's retail investors, continued prolonged retail investors, new class of retail investors in the market is ultimately a good thing because it allows a different investor base to share in a company's success. So I think that's ultimately a good thing. The retail as a percentage of the market obviously hit peaks during the pandemic when we were all at home, locked down, whatever the case may be. You've seen retail come off a bit this year. Probably because they're trying to figure out what the market is doing. Is the market meant to go up? Is the market meant to go down? So I think the volatility may have some retail sitting on the sidelines, but ultimately we see retail participation continuing to be just further proof that public markets are good. Public markets allow democratization of returns and delivery of returns to a much broader shareholder base.
What's driving the markets more, geopolitical tensions or what the Fed is doing?
I think what is driving the U.S. market is what the Fed is doing. But you can't be sure on any one given day. I mean, even the day, I remember February 24th when Russia invaded the Ukraine, I think the market was down 900 points. So it really depends on any given day.
Lastly, what role do capital markets play in bridging divisiveness between countries?
Yeah,
Especially
I think
if you look at the president of Ukraine spoke, and we know the delisting issue with Chinese companies has become, a hot button one. I mean, how do you see your role in helping to maybe close those bridges?
So I think the NYSE has a really unique role to play in global capital markets. I think the U.S. is the home of global capital markets, and if anything, NYSE is the platform for those global capital markets. It's really something that led us to form something called the NYSE Institute in July, because I think that business-minded people can figure out solutions in a very different fashion outside of the geopolitical tensions. It's what's led us to this year sign 3 different MOUs with local regional exchanges, including SGX, Japan, and most recently Johannesburg, because in my mind, we're here to continue to allow capital to flow and to have common standards to the extent possible, allowing that global capital to flow.
Lynn, we have to leave it here for today. Thank you so much for joining us.
Thanks for having me.
Thank you, everyone.
So we have one more session, and then there will be a break, I promise, and coffee and tea and not quite alcohol because they said we couldn't serve it yet. I want to introduce our next guest. He is the founder and CEO of Social Capital, Chamath Palihapitiya. So Chamath, you've had this long career. I mean, you started AOL back when AOL was a thing, Facebook, Social Capital, and we will talk about all this. But most recently, or more recently, the reputation you got over the last couple of years was as the SPAC king. So yeah, you might not want the crown now, but you had the crown. So let me just start with, what about SPACs originally attracted you to it? Because it's not like you were like Alec Gore's who've been doing SPACs for years. What attracted you to it?
I think that if you look at the process of building companies, the problem is that there is still too few people that provide capital to companies in critical moments. And it causes all kinds of distortions. And one of the most non-obvious distortions in the market is that we tend to fund easy things and we tend to run away from harder things because harder things tend to require more money. And there's a really bad trade-off that happens between investors and entrepreneurs. So the observation was that if you had a SPAC, it was a very elegant way for highly qualified investors to just put a lot of money into a company in a moment where that company also had to build a model, explain themselves, understand their business. And I think that that was what originally attracted me to the thing. And so, the first 4 deals that I did were really capital-intensive businesses: space, real estate, banking, healthcare. These are and then the last 2 deals I did were in chronic kidney disease and ADHD. So these are not things that you can just spend $2 or $3 million and go to an incubator and the problem is solved. And so we had to raise billions of dollars. I think we raised more than $3 billion across these vehicles, not just from myself, but from other smart investors. And I think that was what attracted me.
I'm wondering, the SPAC boom partially came after the pandemic or during, but it also came at a time when you still had this massive bull private market, right? You had not just firms like Social, but you had the Fidelities and the T. Rowe's, huge amounts of cash going to the private markets. If you were a startup or a privately held company that had those capital needs, you could get it from private investors. So why bring them public?
You could not get it in the way that you needed. And all of those companies basically needed very large amounts of capital in one fell swoop, which would have been extremely dilutive in the private markets. And the reason is because the private market investor's job is to buy themselves a margin of safety. And their margin of safety is time. It's not liquidity, right? So if you think in the marketplace, you have two choices. You know, I could take $1 billion of risk today. If I do it in the public market, the great thing is I could sell it in a nanosecond. I could buy it right now and I could sell it in a second from now. In the private market, that's not true. So I have to buy myself duration. So what do? You price the thing at a point where you give yourself a lot of ownership and a ton of time. The problem with that is that a lot of these great entrepreneurs could lose control of the business. It could get misdirected and misrun. And so I don't think that's actually true.
You know, one of the, if not benefits, at least one of the selling points of SPACs for sponsors and for the companies that were going public was they were allowed to provide kind of more or longer forward guidance than were companies going public via traditional IPOs. So if you were a company, say, that hadn't even commercialized yet, you could talk about maybe what you were planning or expecting in 4 years, 5 years, whereas if you were going public traditionally, you could only go 2 years out. So I'm curious, was the rule wrong to let companies talk so far out, or is the rule for traditional issuers wrong that it only limits them to a couple of years?
I'm not sure that it's true that in a traditional IPO you can even speak 2 years out. You can speak in the past, but you're not allowed to speak about the future.
Fair, yeah.
So even if you wanted to talk about next quarter, you couldn't. But if you're asking somebody for $1 billion, I think it's a fairly reasonable trade-off that you have a chance to explain yourself. What do you want to do with that $1 billion? Are you going to go and buy a bunch of Kind bars and upgrade your offices and give it to WeWork? Or are you going to invest in sort of fundamental technology which has this sort of payback cycle so that the investor has a chance to transparently decide whether that risk is worth it for him or her? So my perspective is that that is a thing that has to get figured out if you want a vibrant capital market. If you want entrepreneurs to go after hard problems where you need a ton of money, at some point that problem will need to be solved, not just in the private markets.
The Kind bar WeWork strategy might have worked better for certain companies that went public via SPAC than what has happened. So my big question, and leave your deals not aside, but incorporate, what went wrong for the market as a whole? Because the vast majority of SPACs are getting crushed.
We are learning what went wrong, which is that we had a decade plus of zero interest rates. That is what fundamentally was wrong. It perverted the market. It distorted reality. It allowed manias and asset bubbles to build in every single part of the economy, whether it's digital trading cards or art or cars or real estate or NFTs.
But SPACs have gotten hit more than most,
no, that's not
public,
true.
most public securities.
That's not true. So if you look at the SPAC index, I think as of Friday, the SPAC index was down, I think, 56%.
Yeah.
That is not true for some tech companies, which are down 80 and 90%.
For some, but not the indexes.
Of course, you're right. The S&P index is down 22.5%.
Yeah.
The point I'm trying to make is that when you provide free money into a system, manias will build. And these manias were broad-based. And now that we've taken money out of the system, these manias will end. And you will find the market clearing price for a lot of securities. And I think that that's a healthy process. But I think it's unfair to just look at one asset class. It was broad-based. There are some great tech companies that have been, re-rated meaningfully worse than, a bunch of SPACs, as an example. Like, is Coinbase a bad company now that it's down 80% from its IPO price? I would say no. So did it matter how it went public via direct listing? That isn't the point. The point is that we had misallocation of risk because the central bank was giving all of us free money. And we all took advantage of it, and it influenced us essentially putting a pause button on the part of our brain that said, let us actually price this risk appropriately.
One of the criticisms of SPAC sponsors, and you're part of this because it's been written about you and about kind of some of the SPACs, is that sponsors often can and do get out of the deals, make money, and then the companies fall, and the retail investors who bought in end up kind of holding the bag. Is that a fair criticism, and how do you view that? Because you've done fairly well in your SPACs in aggregate, even though a bunch of them are trading well below where that $10 price.
I think there are people, when given all of this free money in the last few years, that bought all kinds of things and then held them for all kinds of periods, and then at some point, some of those folks probably made money in certain securities. Some of those folks didn't. For example, you can look at take the top 5 tech stocks. Those represent what, a quarter of every single dollar of the S&P 500. Did some retail investors continue to hold those all the way down? Probably. Well, what's the recourse? Should we be able to go and ask, Sundar and Zuck and, Andy Jassy, what do you ask them? For the money back that they lost? Like, the point is that...
Well, you asked Mark what the hell he's thinking, but that's different, yeah.
I did not mention Zuck, but yes, you could ask him as well. The point is that the markets are about making informed risk-reward decisions. And there is no easy way out. This is not a game that was meant to be gamified on Robinhood with confetti in an app. That's not what this is. If you're really going to try to be good at this business, and I've been doing it for 11 and a half years across multiple asset classes, what I have learned is that it is really, really, really hard. And the biggest thing that I learned was how much of my early success was probably not attributable to myself. So on the same way that I sort of blame Jay Powell for zero interest rates, I think I massively benefited from Powell and Bernanke and Janet Yellen before.
Do you get a sense that venture, because I mean your primary job is as a venture capitalist, that venture capitalists, call of your generation, your era, who've been doing that period of time, do you feel they've internalized that? Because I've heard you say that before, that the zero interest rates really gave you a major
There's
tailwind.
A narrative fallacy in Silicon Valley. We have been telling this lie, which is that this is an artisanal craft business. It's not true. We have actually had a massive tailwind because we had a zero interest rate environment that allowed us to raise unbelievable amounts of money from investors who frankly had very few other alternatives because interest rates were zero. And what it allowed us to do is crowd into companies. Many of those companies had unbelievable valuations. Eventually, these unprofitable businesses went public, and only now are we starting to sort out what are good and what are not so good businesses. And the entire time, people would say, this is an artisanal craft business. What I would tell you is it's absolutely not that.
What is it?
It is like every other asset class in investing, which is that it is about a systematic model of risk management, capital allocation, and the insight to make good investment decisions, which may not be the answer that a lot of people want to hear, but it is the truth. I'll give you just one example, okay? Over time, in our organization, we've invested more money in every single fund, okay? Starting in 2011, it was a $275 million fund. Our 2019 vintage was $1.5 billion. Okay, we've had different LPs. Sometimes it was all entirely my own money. Other times it was me and LPs. We've been in all kinds of markets. And in that entire time, what I've realized the most important thing to do is we manage risk really carefully. We think about correlation. I talked about this on the All In podcast, which is when we do a deal, how often are we crowding in with other people? The more crowded you are and the more correlated you are, the more at risk your returns will be. We've compounded at 32.5% for 11 and a half years. Every single fund is top quartile. Every single fund, by the way, is almost crystallized, meaning, so my point in telling you this is, it is possible to run it like a boring machine.
A piece, you talk about being an artisanal business. The other thing that kind of rose up in the last 10 years was this concept, I'll say generically, of value add. We, not just sitting on the board and helping, make an introduction to the head of engineering somewhere, but, lots of support services and marketing services and tech services, et cetera. Do you feel all that starts to fall by the wayside? Because entrepreneurs had gotten to the point where they viewed VCs primarily as just money and viewed them on the boards as minor annoyances.
I think that part of why that may have happened is that we are undereducated as practitioners. I think a lot of venture investors are unfortunately financially innumerate. They don't understand risk management, correlation, alpha, beta. They don't want to learn about these things. They're afraid of what it means to confront an entrepreneur.
Can I ask quickly, is that because the industry changed? 20 years ago, so many people were either coming out of banks or maybe even out of consulting firms, whereas the shift was, and granted, to be honest, you're kind of part of this from a resume standpoint, people started coming out of tech companies and from operational roles.
It doesn't matter where you come from. Some people have investing mindsets, some people don't. You can resume build in any organization you want, but when push comes to shove, the ability to take risk and make money in all market conditions is a learned skill. It's not a behavioral thing that you're born with. And I think that people who embrace the development of that skill, who want to develop mastery, will do really well. Venture capital has never had to do that because it's been very small and cottage. However, we now see that technology is absolutely pervasive in society, that it will lead us out. right? If we're in a recession over the next 2 years, what will lead us out? It'll be this kind of growth.
Are we going to be in a recession in the next 2 years?
Absolutely, yes. So
It's on the record on that.
I mean, I hope it's not true, but I think the odds are very, very high that we are. But my point is, tech will become, and venture capital will look like in the next 20 years, private equity and hedge funds and everything else. Systematic, systematized, right? Mechanistic.
Okay,
That's good.
It's interesting you say that. So for what it's worth, I reported recently that Chamath is out trying to raise money for social capital. He's not going to talk about that because there's probably someone from the SEC here, and he'll be let out in handcuffs if he does. But let me ask one of the. Unless you wanted, do you want to talk about it? You want to talk about fundraising?
I mean, I've been handcuffed before, but not by the SEC. No, just kidding. Go ahead.
BFD After Dark will be tonight, starting at 10 p.m. down the street. Let me ask. One of the things when you changed social capital, which you said had been a traditional firm in terms of raising outside capital, and you kind of moved into a family office. One of the things I heard at the time was one of the things you had been doing internally was making the firm, call it a little bit more algorithmic, and feeling that the human touch in terms of investment decisions maybe wasn't needed as much, and you could maybe automate some of that. A, was that correct that you were doing that, and B, were you right?
It was correct, and no, I was wrong. It didn't work. But it's a very good question, and again, it goes back to what does the venture industry need to do to really mature to meet the opportunity at hand? Like I said, we need to be more mechanistic and look like everybody else. And so in our organization, I have a North Star. Now, this may really not be appealing to certain people, but our North Star is what is our aggregate rate of compounding. That is it. Nothing else matters. And every time I feel that we're decaying, and there's a couple of sub-metrics underneath. Another metric, that we have a table, it's like the wall of shame, okay? If you walk into our office, you'll see a table. On the left-hand side, it's where we've made our biggest winners. $1 billion here, $500 million there, whatever. But on the right-hand side is our biggest losers. We have never lost more than $27.5 million in a deal, ever.
What deal?
Well, there's been a couple
I
of
mean,
these.
it's on your wall of shame.
Yeah, I mean, Sprig, we lost 27 million. Premise, we lost 27 million. But there's a bunch of these. I'm happy to tell you.
Yeah.
But my point is, the ratio is 24-1. Why is that important? I think it's really important to make sure people understand walking in the door what the goal is. The goal is not to make friends with entrepreneurs. It's to have them respect you, not to like you. The goal is to return a ton of money back to your LPs. That is it, and that's measured in that one number. So I would experiment a lot with different ways to do that job. Big teams, small teams, generalists, sector-specific experts, always guided by that thing. So Dan, what you saw was a lot of my experimentation. And by the way, for those of you guys that understood what I did at Facebook, that's what I built. It was an experimentation machine. It was how do you build the machine to build the machine? And I think investing can be done the same way, and I set out to do that here as well.
I wasn't going to ask you this, but I'm curious. You just brought up Facebook. Your job at Facebook was in charge of growth, basically. If there was, and they've plateaued at least on the Big Blue app. If you were back at Facebook, what's the one thing you would do to get user growth going again?
Look, I just did the Lex Friedman podcast. It'll come out in the next couple of weeks, and he asked me this question: what would you do if you were CEO for a day? I'll give you the answer that I gave him, just to be consistent. I think that Facebook is probably the best company in a position to build the critical piece of AGI that is not yet available. So if you take AGI and you decompose it, this is just basically general intelligence. I think that you can summarize AGI as there's cognitive compute and then there's reasoning. That's how your left and right brains work together. You can do math and you can emote, right? You can feel, and you put the two together, you reason. If you think about what Facebook has, is they have the most prolific data set on all of that emotional reasoning. Every single reaction to every single possible stimulus is actually documented in every single Facebook post, WhatsApp message, and so the idea that you could take that and Instagram and pour it into a learning system. So if I were the CEO for the day, I would probably double click into that idea. It takes meaningfully fewer people than are probably there. It takes a lot less money than one has to spend to build the complicated hardware infrastructure, but it's deeply differentiating over the next 20 years.
You brought up earlier the podcast, and for those who don't know, Chamath is one of 4 regular people on the All In podcast.
Besties.
The besties, right. So let me actually add, so the conceit of the show is that you are 4 friends, you have different opinions on different things, and you get together either virtually or in person, and you have a conversation. It's almost kind of like a group of people over a bar or dinner table. it's become, I will just say, weirdly popular.
Weirdly,
I mean,
weirdly popular.
Weirdly popular among people who don't necessarily care about what you do for a living. You've obviously gotten in some trouble for some things you've said on that show. I'm curious, given the popularity of it, do you now find yourself sometimes checking yourself, or do you feel greater responsibility for everything you utter on it? Because it isn't just four guys around a table at your house. It's going out and a lot of people are listening.
Yes and no. I think what I've learned is that as I've evolved as a human being, as I've had a little bit more professional success, and as I've frankly just like learned to have healthy relationships around me and all of that stuff, I've become sort of like a better, calmer, more focused person. I think that the pod is a very good way of doing something that Silicon Valley desperately needs, which are reasonably decent brand ambassadors out to the rest of the world that show that old caricature of like this dilettante person in, trying to ape Steve Jobs in the way we dressed. That's like, that chapter is closed. And that there are professional, serious people there that understand how to interface in the rest of the world. And I think that that is part of my responsibility now. I mean, I'm old, I can't do this. I mean, there's these things that were written about us and me, whatever, at Facebook and even Social Capital. That works when you're in your 20s and 30s. The dog doesn't hunt when you're 46,
I'm curious.
So the pod is just a way of just showing that level of intellectual rigor that other people can attach themselves to that says, oh, these are normal people. They're not, running around in T-shirts and Birkenstocks and
You said that. I'm curious, though, if something, not even if something controversial comes up, I assume when you're sitting there and you say something, and obviously the Uyghur line is the one that some folks remember, do you in your mind think, oh shit, that's going to be everywhere on Twitter, or do you not? I will tell you, somebody who sends a newsletter out each morning, I'll tell you, the minute after I hit send, I spend the next 5 minutes just staring at my inbox, waiting for the, oh, you really screwed this thing up emails to flood in.
I don't think too much about it, to be honest with you. We ship it. I always watch it in its entirety, end to end, just so that I have the full context, usually that Friday night or Saturday morning, and then I kind of move on. Most of the time that I'm spending is just doing my day job. People ask, how do you prep for it? And I would really encourage all of you, find a good group of friends. I have such a group. We have a group chat, and the whole point of the group chat is dump interesting things that will challenge the way that you think. And it's a safe space for us. We do it on Signal, so the messages get deleted as well. But we really go after each other and push boundaries around what people think. And it allows me to build a mosaic. And so I really come in, I do a 15-minute prep for All In. Now, you may say we should do much more, but that's all it is, because it's important to just have a snapshot of your mosaic at that moment in time.
I'm out of time, but I'm going to ask one final question because we discussed it backstage, and this kind of goes to your day job and what you're doing. We had a story yesterday, Sarah Fisher, who you'll see in a couple minutes, wrote a story about Mr. Beast raising a ton of money. I'm just thinking about what you do in terms of investments, and you had some interesting thoughts just in terms of thesis, in terms of kind of the change in creators.
Yeah, I mean, look, if I could leave you with a parting thought for all the investors here in the room, but also the entrepreneurs, I think there's these two tectonic plates that are moving in the world that I would just encourage you to pay attention to. The first is that because of all of this money that we've written into the last three big laws, the BIL, the CHIPS Act, and the IRA, we are pulling forward America's energy independence. The cost of producing energy in this country is going to be zero before you know it. At the same time, the cost of marginal compute is going to zero because of the amount of chips that we're going to be able to spin up using GPUs, ASICs, FPGAs. When you put these two together, there are going to be enormous implications to the energy infrastructure, to healthcare, to all of this stuff that's worth paying attention to. Most of my time is decomposing that problem to map out where I want to put money. There's one outlier to this, and that is related to content creators. I have never, ever looked at consumer investing since I left Facebook. Just to be clear, ever put a single dollar.
You also said you stopped using Facebook when you left Facebook.
I did. So if you look at the platforms, Apple and Google, those guys over 5 or 6 years, in the first 5 or 6 years where they established their platforms, Android and iOS, billions of MAUs, monthly active users, trillions of dollars of enterprise value created. Then in the mid-2010s, Facebook, Snapchat, TikTok, WeChat, QQ, billions of MAUs aggregated, trillions of dollars of enterprise value. Content creators, billions of MAUs have not yet seen the trillions of dollars of enterprise value created. So other than energy and compute, on the consumer side, this is the obvious tidal wave. And so the thing around Mr. Beast, whoever does that deal will be a really good-looking genius.
Will that be you?
I mean, I'm not doing this deal, no, but I'm just saying.
Just checking. Chamath, thank you very much. slow because everyone is wheeling and dealing in the corner. So I'm going to come out here and shout for 5 seconds to get people to settle down and pay. Oh, it worked. All right. Good for all of you folks. I'm Nick Johnston. I'm the publisher of Axios. It is great to see so many of all of you here, like Dan and my boss, Jim Van Hise, said earlier. This is really the realization of a great dream we've had at Axios for many years, and none of it would be possible without our great journalists, our great events team, and also without all of you. Like, none of this is possible without the folks who have subscribed to our newsletters, who've been subscribing to Pro Rata for the last 6 years, the folks who have signed up for our deals, newsletters. Thank you so much for joining us and being a part of this and making this happen. And of course, this wouldn't be possible without our great sponsors and partners. And one of those folks who've been with us from the very beginning are the great people at JP Morgan, who have been a friend of Axios for very long and are a great partner and sponsor for us today. So I really want to welcome to the stage for a view from the top, Anu Aegor, the co-head of global mergers and acquisitions for JP Morgan. Anu, welcome. So I think we would start this off. We've got, some time to kill. Why don't we just go through the list of confidential and proprietary terms of the Twitter deal and just get that one out of the way to start.
That was not a part of the deal. So, but just in case Twitter came up, our lawyers gave me what to say.
read, all right. Do what the attorneys need you to do.
The company, our client Twitter, plans to close the deal on the previously agreed price and terms. You can no longer get me into trouble.
And there's no Elon Musk tweets in his draft folder that the lawyers are looking at?
Nothing.
You can read the statement again if you'd like.
The company plans to close the deal on the previously agreed price and terms.
Let's put that one aside. Your boss loves to talk about macroeconomics and what the Fed is doing, and he has no shortage of hot takes from him on what is happening in the global economy. But I'd love to hear from your vantage point as an M&A chair, what does the global economy look like for you? What are the trends you're looking out for?
Yeah, I'm not as good a weather forecaster as he is, so I'm not going to talk about hurricanes or storms. But I think from the M&A market I split it into two pieces. The drivers of the M&A market and the facilitators of the M&A market. Drivers, why do people do M&A? The strategic need for M&A, strategic need for growth, supply chain considerations, geographic considerations, dealing with coming out of the pandemic, dealing with higher labor costs, dealing with declining margins, dealing with the changing demand of the consumer. All of that is not only intact, but even more urgent. However, the facilitators of M&A, which is cheap capital, cheap debt, strong stock price, boardroom confidence, those are a little murky.
But we've talked about this before. You mentioned to me the other day that in a market like that, of that uncertainty, if you have capital, that's great.
Yeah.
If you don't, what does that mean?
Yeah, so it depends a little bit. In some ways, this is much more of a buyer's market. So you don't see sellers proactively saying, let me go and put the company up for sale. But if you are a large strategic investment grade, you have capital at hand, or you're a private equity firm who has a big new fund, and you can over-equitize a deal today, this is a great environment. Because again, the headlines will say premiums have gone up. But if a stock is down 70%, and last year you were going to pay a 25% premium, and this year you pay a 50% premium, you're still buying it at a value, headline value that is lower. Then it, of course, depends on what the underlying earnings are and what the multiple is.
But if that trend line is going down, wait and get it next year for even less.
Well, it may be actually worth less next year because franchises also get affected.
Right.
So determine what is the capability, technology, or gap that you're trying to fill.
Right.
And then I wouldn't wait for the bottom. Instead, if it makes sense, go after it proactively.
Because the long-term upside, I mean, it's a little bit about having courage. I mean, of course the banker is going to say, have courage.
Not just courage. I think if you look back at history, 2008, 9, 10, very little M&A activity happened. But the people who did do deals, who had the financial wherewithal and the liquidity and the capital to do strategic deals, long term, the verdict is that they did really well.
Right.
because those deals made sense.
Let's go into the boardroom. Like when you have those conversations with corporate leaders, how are those conversations unfolding? What are their worries and concerns, and how are you assuaging their fears?
Uncertainty doesn't help for M&A. It's less what is the level of the market. So if the market goes down 20% and just re-rates and stays flat there, that's not actually an issue for M&A. What is problematic is the movements like that. And that doesn't help because that's uncertainty. So right now you have uncertainty around valuation, interest rates, inflation, recession, health of the consumer, regulatory.
You needed two hands for all that list. Like, okay, if I'm in a boardroom, I'm like, forget it.
So that is not conducive to say, let us go on a buying spree or let's go sell ourselves. However, it is the exact time to say, which company was always on my radar, and I could not do it previously, either because there was a lot of competition, or I thought I was going to lose to a sponsor, because that's what was happening last year. And now, proactively reach out. Start developing the relationship so that whenever it is that the seller decides to sell, you're first call.
Right, and so it's somewhat talking through some of that corporate leader fear, because they see those 6 things, they see the market bouncing up and down, and they don't want to act.
Yeah, and what we are interestingly seeing is boards in corporate America becoming very involved in the strategic direction, and oftentimes giving the support that the management team needs. Because the management team is sitting there and they are watching their stock price every day. They're getting on those earnings call, and they're going to have answering some very tough questions.
Yeah.
And the boards, especially some of the really good boards, and there's been huge change. Lynn, who was here earlier, she talked about how boards in America have changed a lot. Boards are really giving a lot of support, guidance, and counsel to management teams, and that's exactly what we need them to do.
Can we unpack this even more industry specific, right? Where are the, what are the trends? I think we talked about this before. Like who's having fun and who's not having fun? What are the industry or sectors where people are maybe hearing this call to act strategically in an uncertain time?
So last 2 years has been all about tech. In fact, last year, 40% of the market came from companies which call themselves tech. That trend of tech continuing to be active is still there, but a sector, if I have to look outside into my cloudy crystal ball, I'd say healthcare, where you've seen less activity in the past. When we were chatting in the back earlier, Chamath was saying that when you look at companies and the number of patents that are falling off, there is a need for, especially in biopharma and life sciences, for companies to actually look at M&A as a part of their toolkit, in addition to organic growth.
Right.
If you look at historical downturns or recessionary environments, healthcare activity, M&A activity has been on the higher side. So I expect a little bit more balance between tech and healthcare.
Right.
ESG-driven activity, which has been talked a lot about.
So what does that mean?
Renewables, industrial companies looking to buy technologies which
broaden
makes
their
them
portfolio
more,
to fulfill that.
yeah,
Okay.
ESG friendly. I have heard more talk about it than action, so time will tell whether it translates to action.
And then where are the places where you're seeing where it looks more worrisome, or a much slower pace?
I'd say deals which require a significant amount of leverage finance.
And is that
So the
sector specific?
traditional sponsor take privates with a bunch of leverage on it. So if it's a sponsor take private where you're over equitizing it, it's still happening. But if it's a sponsor take private which is reliant on huge leverage finance, then less so. And also I'd say parts of tech where if your stock is down 70, 80%, then companies are much more in defense, protect mode. And even if somebody makes an overture to them, they're like, this is not a good time for me to sell, and I don't want to sell.
Right, so they'll hold on to it. In the minute or so we have left, you are a participant, thank you, of the very first BFD, which I'm sure is a family-friendly acronym, Ask Primac. But if
I
we
had to actually ask what it meant.
I'm not going to say it up here. If we actually, if you came back and we did this again in a year, looking back at the year ahead, what do you think the BFD in the next 12 months will be?
Look, I think downturns separate the good and the bad. And for people who think strategically, who play offense and who are proactive, they will come out being winners. And if you wait too long or hold on to your capital and don't deploy it, you may regret it.
Okay, you're kind of dodging this. This is an M&A banker saying the 1-2 winner are going to be the ones doing M&A.
Well, if you do the right M&A deal, strategic,
Right.
proactive, totally makes sense, and don't stress your balance sheet out.
Got it. Anu, thank you so much for being a partner for us. Thanks for joining us, and thank you all for being here.
Thank you.
Hello, everyone. Thank you so much for joining us here today. Our next guest is somebody who I'm sure many of you know, Jimmy Pitaro, the chairman of ESPN and sports content at Disney. Jimmy, welcome. Jimmy, thank you so much for taking some time out of your busy schedule to meet us here at Axios BFD. We heard a little bit about it this morning, but you announced a deal this morning, obviously selling a majority stake in the X Games. Walk us through why you're doing that. Why was now the right time?
First off, we take a ton of pride in the X Games. It's 27-ish years that we have been in that business, the action sports business. It's an important property for us. We talk a lot at ESPN about audience expansion. It's a challenge for everyone in the sports industry. How do we attract younger fans? And X Games was definitely a huge component of that. But when we looked out and we looked at where we were making our investments and how we were prioritizing, we were a bit concerned about how much time we could continue to dedicate. You know, we all have to make tough decisions every single day in our businesses. How much time could we continue to dedicate to X Games and action sports? And then we sat down with some folks, started to have some conversations, and the folks at MSP kind of blew all of us away at ESPN in terms of their vision and how they could kind of take this to the next stage for us. And we kind of regrouped on our side and said, you know what, this was compelling, their vision on X Games, and we want to stay involved. We, of course, want these games to be broadcast on ESPN. We want to maintain an interest in this enterprise, but we trust these guys. They have a great track record, and we're going to go with them. So yes, we closed the deal and announced it this morning, and we'll see how it plays out, but we're excited about it.
But that need to reach younger audiences, that's not going away. So what's the next big investment that you're making?
Yeah.
What's your next big X Games to bring them in?
Well, look, I'm going to state the obvious. It's social, how we're showing up on social. I think we're doing a really nice job today. If you look at what we're doing on, for example, Instagram, on Snap, on TikTok, we're the #1 sports brand, of course, across all those properties. And it's going really well. If you look at the data, if you look at our research, what it shows us is that we bring them in, we grow awareness, we grow affinity through social platforms, and then they actually end up spending more time on our owned and operated properties. Like, for me, that's when the angels start singing. You know, it's exactly the strategy. We want to get them excited about ESPN. We can't expect that everyone, especially younger people, are going to come to our owned and operated properties, so we need to go where they are, which is many of these social platforms, and we're showing up well. When you look at what we're doing on these platforms, it's a combination of two things, right? We're looking across the internet, trying to find content that is consistent with our brand, that has the heart, that has the humor, that really represents the ESPN brand so well. And then we're pulling it into our handles. Then we're also creating natively, we're creating content for these platforms. We're creating shows. For example, we have SportsCenter on Snap today, which is going very well.
Okay, so the challenge, though, would be that you have brands like Barstool who are really tapped into the zeitgeist ESPN is a little bit of an older brand, obviously. So how are you competing with those sort of younger emerging brands, the Overtimes, the Barstools, while still staying true to the ESPN ethos?
Well, for example, we're hiring a guy named Omar Raja, who we hired a few years ago, who's fantastic. By the way, he's not just behind the scenes, he's actually talent. He shows up on social platforms, he actually shows up on our air, on linear television. He's doing a fantastic job. He resonates, by the way, if you look at our research, he resonates not just with younger people, but he resonates with people like me. He resonates with, my dad loves him. So we're looking at bringing in, identifying talent, bringing them in talent, again, that we think are consistent with our brand, not mean-spirited. It's very easy to bring people in that are looking to generate clicks and they're not kind of connected to our brand. But again, I mentioned before, heart, humor, not mean-spirited content that we think represents us well. That's really the priority here.
Because we're at the BFD conference, we're focused on deals. Wanted to talk to you about a few other deals that have been in the news lately. Bloomberg reported that ESPN and DraftKings are close to brokering a large deal in terms of sports betting. Is that true?
Well, I can't comment on any media speculation. What I will say is that if we did absolutely nothing in this space, it would be good for business, right? The more people that are placing bets, the more invested they are in games, the more likely they are to watch games, and that's great for ratings, and that's great for ad sales, and that's great for our digital presence. That said, we are, of course, we are doing a lot in this space. We've been active in this space for many, many years, and it's going well for us. So if you look across our various platforms, if you look across digital, if you look across direct-to-consumer, linear television, we have shows that we've actually launched over the past couple of years dedicated to sports betting. We take a lot of pride in our alternative broadcasts. For example, we did an NBA alternative broadcast that was specifically focused on sports betting. We have podcasts. We're hiring new talent. We've just been massively invested in this space. We have link-out deals with DraftKings and Caesars. Now it's what's next.
So, but in terms of what's next, you all have said that you're never going to actually be a sports book.
That's
You'll
correct.
never facilitate bets. Why?
We just don't feel like it's appropriate for us to be creating a book. We're not interested in actually being the place where people place their bets. The technology, many of you in this room probably know the technology is incredibly complicated. A lot of folks, a lot of enterprises out there actually were already invested in this space, and they went out and they made acquisitions on the tech side. And so if we were to try to do this, it could take years before we were really, ready to be up and running. So, but it's more about how we see our brand, and we believe that partnership, it would be the right approach for us. Again, we already have partnerships with Caesars and DraftKings. Then the question is, okay, what's next for us? And that can take a variety of forms. We know that our brand has a ton of credibility, a ton of trust. We're contemplating whether we should leverage our brand in that capacity. We have links already. I mentioned the link-out deals. We have links around our sites. Can those links be more prevalent, more seamless?
And that's what you mean by leveraging your brand in that capacity?
Yeah, well, when I talk about our brand, I'm really talking about the trust and the credibility that would convey to a sports fan or a fan that's looking to place a bet. When I talk about the link integration and essentially the promotion, we can be doing more of that. We have some of it across our sites, across our apps. Can we be doing more of that? Can it be more seamless? Can we be doing a better job at promoting this type of offering across studio programming, across live games? We're starting to think about that.
So essentially going back to the leveraging the brand, would that be like you licensing to a third party access to the ESPN brand so that when someone's issuing a bet, let's say on DraftKings or FanDuel, there's a trust there because the ESPN name is there?
Look, everything's been on the table. We've been contemplating a variety of scenarios in terms of that next step for us in that space. But I will say that we have a lot of faith in our brand and our research. We've done a ton of research in this department. And what we've seen is that our fans are not just okay with us doing more, they're actually expecting it. And so we believe that it's going to be a brand deposit, not a withdrawal, if we were to be more aggressive here.
This is an interesting time for ESPN. The last time Jimmy and I saw each other was several years ago when you were launching ESPN+. But coming out of the pandemic, there's a ton of momentum. Live sports are doing well. And yet there was still an activist investor, Dan Loeb, who pressured Disney a few months ago to spin out ESPN. Ultimately, the two parties came to an agreement. But I would love your take on that activist investor push. What do you think was really motivating him? Was he trying to just drive down the price so someone else could buy it? What was the intention there?
I don't know. I haven't met him. I haven't spoken to him. But I will tell you that Bob Chapek has been clear and consistent that ESPN is an important part of the Walt Disney Company, an important part of the future of the Walt Disney Company. It's connected to our strategy. Folks at Disney, folks on our board, they see the value of live sports. I think last year, 95 of the top 100 broadcasts were sports. Folks at Disney see the value in the ESPN brand. They see our strategy. You know, we do a 5-year plan. We talk about our 10-year strategy. There's a lot of confidence and a lot of faith in terms of what we're doing over here, and it's going really well. I mean, it's so fashionable right now to talk about all of the challenges in the sports industry. Talked about younger people, cord cutting, and yet in the middle, all the new competition. You know, Amazon and Apple, you know, now entering the space. What's Netflix going to do? It's again very fashionable to talk about all the headwinds that we have, the other incumbents in the industry have. And yet, in the middle of all this, we actually, in 22, have broken records. When I say broken records, that's across linear, that's across digital, that's across social platforms. And so we take a lot of pride in that. And I think, well, I know that the folks that are in Burbank, the folks at the Walt Disney Company, they see what's happening over here, and they see the success that we're having across these various platforms, and the fact that we are not just a linear network. We take a ton of pride in our linear networks, but ESPN is far beyond just one or several traditional linear networks. We are a multi-platform sports ecosystem.
But is the revenue from your other bets outside of linear growing fast enough to one day supplant linear when linear dies, which is, it could be within the next few years?
Look, it's a great question. I don't have a crystal ball. I don't know how that will play out. What I will tell you is that as I sit here right now, the plan is parallel paths. So we still very much value this traditional ecosystem. What I mean by that is linear television. When we acquire rights, we are acquiring rights not just for digital, that gets all the attention in the media, but we acquire rights to this day for our traditional platforms. So it just continues to be a priority, the linear business. But again, in parallel is direct-to-consumer. So we launched ESPN Plus in April of 2018, so it's been over 4 years now. We take a ton of pride in where that platform is. It's going far better than we forecasted. As I sit here, I think we announced close to 23 million subscribers at our last earnings call. That was the last number that we gave publicly. I think it was around 22.8. But the idea is to continue to make investments in both linear and direct-to-consumer. And you know, our mission is serve the sports fan anytime, anywhere. If you want to access ESPN through DirecTV or Comcast, we're going to be there and you're going to be able to. Today we have ESPN Plus. There might come a point in time where ESPN flagship is available a la carte. We're not there yet. As I sit here right now, we are not, I will say without any reservation, we are not there yet. We are very happy with what we're doing on ESPN Plus. But yes, we will continue to run these parallel paths.
So when you're thinking about the rights for linear, for example, there are a few tentpoles that are coming up. Obviously, there's been some headlines about the Pac-12 negotiations. Where are you on that? Do you think you're going to retain those rights?
So look, we're coming out of the pandemic. We're looking at a string of rights acquisitions that is probably our most impactful string in our 43-year history. NFL, NHL, SEC, La Liga, Wimbledon. I mean, I can go on here. So our rights acquisitions team was really busy during the pandemic. We got a ton accomplished over Zoom. But to your point, there's a lot coming. There's Pac-12, there's Big 12, there's college football playoff expansion, which has been reported on publicly. There's, of course, NBA. Now, we have several years left with the NBA. We have several years left on the college football playoff, but we're starting to have those conversations right now. One thing I will say, Sarah, is we can't have everything. And so we saw that play out with the Big Ten. They came to us and they were offering fewer games at a higher price. And ultimately, as Bob Chapek has said consistently, every deal that we do has to make sense for our investors, has to be accretive. And we have a pretty sophisticated rights acquisitions team. We model out every deal. There's no guesswork here. And so we just unfortunately could not make sense of we love the folks at the Big Ten. We just couldn't make sense of it. We couldn't make it work. And like I said before, we sleep at night knowing that we can't have everything. It just does not make financial sense for our business. But I will also tell you that on sticking with college, if you fast forward to 2024, when our new SEC deal kicks in, we will have 64% of the college football market, which is essentially where we are today. So walking away from the Big Ten does not mean long-term our college football inventory will diminish. It's not the case.
I think college is where we're at right now because Pac-12 expires next year, but you mentioned NBA, and that's coming up in 3 years. Where do you think those lights are going to land, and do you think that they are going to follow the lead of the NFL and start to put more on streaming with tech companies?
Look, I can only tell you what I've read, which is that Amazon is interested in the NBA. No one has told me that. I've seen it reported publicly. I will tell you that I think Amazon has done a nice job with the NFL. I will also tell you that I actually think that that's good for us at ESPN and the Walt Disney Company. So why do I say that? First off, if you look at their average audience, it's about 8 years younger at Amazon than it is for everyone else at the NFL. And so that's good. They're bringing new people, younger people into this football ecosystem. That's going to help Monday Night Football, in my opinion. They're helping to grow the game of football. Number two, they are obviously a direct-to-consumer digital platform. Well, for early adopters of direct-to-consumer, again, we've been in this space for 4+ years in terms of multi-sport, direct-to-consumer investments. Ultimately, if the customer gets more familiar with consuming NFL games through a direct-to-consumer platform, I have to assume that that's going to benefit folks like ESPN who are massively invested in direct-to-consumer. So that's Amazon and how I think this all impacts ESPN. On the other side of it, yes, this is not getting any easier for any of us in the industry. It's not just Amazon. We saw what Apple did with Major League Soccer. There are rumors that Apple is going to be even more aggressive, including on the NFL side. I don't know if that's the case or not, but again, you all have seen that and heard it. It's a tough environment for us right now, and it's not just the new media, the larger tech companies. It's some of the smaller tech companies as well that are coming in and bidding for rights. So I would say it's tougher today than it's ever been. But all that said, I really do like our hand. Like if you look at the power of the Walt Disney Company, what we bring to the table in terms of our brand, our reach, our scale, the quality of our production, the synergy at the Walt Disney Company, the fact that we bring cable with ESPN channels, we bring ABC broadcast, we bring Hulu, we bring the megaphone that is ESPN, all of our sports center promotion, all of our studio promotion. If I'm a league commissioner and if it's a jump ball and I'm choosing between ESPN and the Walt Disney Company and someone else, it's not even a question. I am going with ESPN because of all the things I just mentioned.
Talking about where ESPN fits within the larger portfolio, do you find that you're having more conversations in deals where you're referencing ABC, putting more games on ABC. Are you looping them in more to be competitive than you were?
It's another great question. So let's talk women's sports for a second. So we take a ton of pride in the growth of women's sports. And one of the things that we've been doing over the past several years is moving a lot of our games from ESPN or ESPN2 to ABC. And what you're seeing is numbers are up and to the right on women's sports. So this idea of if you build it, they will come, we're actually, actually seeing it play out. Where as we move games and we forecast numbers, they're playing out. So we feel really good about that. But yes, to your question, in general, we are doing more and more on ABC. We're doing more and more on Hulu. As the majority owner of Hulu, it makes sense for us. And by the way, the NHL deal that we did a couple of years ago is one of the deals that I mentioned. We really got that deal done without any hesitation, I will say, and if Gary Bettman were sitting here right now, he would echo this. We got that deal done because of all the various platforms that we brought to the table. ABC for the NHL final. Hulu has regular season games. ESPN Plus has exclusive regular season games, and of course, our linear network. So it's one of the advantages that we have over our competition is just this plethora of platforms that we can bring from the Walt Disney Company as we enter these negotiations.
You mentioned women's sports. ESPN has a large 11-year deal package that includes women's sports, but there's been some criticism, not of necessarily at ESPN, but that broadcast rights don't necessarily represent the true value of women's sports. Would love your thoughts on that, and would love your thoughts on which women's sports you see have huge potential in terms of deal making.
Look, I definitely think that's accurate, what you just said. And by the way, that's on us, like at ESPN. Like we know that we have to continue to make women's sports a priority. If we're gonna lead in the sports space, a big part of that is leading as it pertains to women's sports. And so, by the way, today is the Sports Business Journal Game Changers event where they're celebrating women in sports, which I think is fantastic. And by the way, my sister is the general counsel for Major League Baseball. And so I love the fact that the industry in general is more focused than ever on, not just women's sports, but women in sport. I think it's fantastic. And by the way, we take a ton of pride on that at ESPN as well.
When we think about deals, right now we've been talking about a lot of transactions, but there's also the deals that ESPN has to make with its talent. You're starting to see, Stephen A. Smith, for example, has a podcast deal with Odyssey, but then obviously has shows with you. How are you thinking about talent in this creator economy where they want to be multi-platform, but obviously you have an incentive to keep them on as many of your channels as possible?
So look, first off, as it pertains to talent, like who are the needle movers? Who are people tuning in for? Stephen A. is a fantastic example of that. Number two, who are our up-and-coming stars like Malika Andrews or Marcus Spears, Dan Orlovsky? I mentioned Omar Raja, Pat McAfee. Like, let's get out there and let's identify folks that are currently on our bench or even folks on the outside like Omar. Those are, I think, the two components. But so what do we bring to the table here? You mentioned like the multi-platform. Stephen A. is, again, the best example where he's doing First Take. He came to me and said, I would like to do this podcast. Long story short, we said, go do it. We're going to embrace the spirit of you doing other things. But also what I said to him is there's a lot of other stuff we can be doing here at the Walt Disney Company at ESPN. So, connecting Stephen with my colleagues at Disney, my colleagues at Hulu, my colleagues at ABC, saying to Stephen, hey, maybe we should be doing an alternative broadcast. So we've had some success with the Manning brothers in connection with Monday Night Football. Maybe Stephen A. should be doing that, something similar for our NBA broadcasts. And so fast forward to today, this moment in time, and tonight we have an NBA doubleheader, and Stephen A. will have his first alternative broadcast, which we're pretty excited about. But in terms of how we retain talent, it's actually not dissimilar to what I mentioned before about deals. And in my conversations with commissioners, we're able to say to our top talent like Mike Greenberg and Scott Van Pelt, hey, we don't just think linear. We have ESPN Plus, and we have Hulu, and we have ABC. We have an assortment of assets, at your fingertips. You just got to let us know. And then the last thing I'd say, I'm kind of rambling here, but the last thing I'd say is come to us with ideas. we say to talent, the beauty of ESPN Plus is it's infinite real estate. With linear broadcast, there's only so many hours in the day. You look at ESPN Plus and our ESPN app, and we can program as much as we want as long as it makes financial sense for us. So one of the things that I've said to our talent is, don't be shy if you have ideas, especially ideas that can help us attract and speak to a younger generation. Bring them to me, and that's happening right now, and I think our talent love that.
So at Axios, we like to finish all of our newsletters typically with one fun thing. And so you mentioned the one fun thing I wanted to bring up, which was, of course, the Manning cast. It's had such explosive success, and it's inspired so many other multicasts around. But do you think that they are an anomaly? Are others going to be able to replicate, including Stephen A. Smith, the same type of ratings and zeitgeist and cultural phenomenon that the Manning brothers have? Because they've up until this point, they've been truly the outliers.
Yeah, definitely lightning in a bottle. Like, they are incredible. The chemistry between two brothers, I don't think anyone would have predicted the way the two of them are resonating. My teenagers are the best example, Sarah, where I'll be the first to admit it's tough to get my kids to watch 4 quarters or 9 innings. But my kids are fully invested and all in on the Mannings. It's authentic. We took a little bit of criticism or a little bit of heat early on when they were talking over each other. I mean, it was coming out of COVID, and we were doing it virtually, and they were in different locations, and it wasn't syncing perfectly. My kids love that. They felt like, the lack of polish out of the gate was actually a net positive for them, if you could believe it. But yes, they resonate, again, just bringing this full circle. The Mannings resonate with my dad, me, and my kids, so we're doing something right there. But yes, we are trying to replicate this success. Hopefully Stephen A. can do that. And then the last thing I'd say, just somewhat connected to this spirit of innovation, is it's all about access right now. If you look at what younger people want, if you look at, we're putting mics, all through Sunday Night Baseball this season, we put live mics on players in the field. Okay, we've always, NFL films, we've always had mics on players, but we did it live, where we had players in the field speaking real time they're actually getting regular season games that matter, getting balls hit to them, and they're communicating with our folks. And again, in terms of what the younger generation wants, they want access to players, and so we're trying to deliver that.
And quickly, before we lose you, is there a particular sport, I know you've expanded the Manning cast deal a little bit, that you're more excited about, in addition to football and basketball, for these sort of multicasts that we should look out for? Well,
we actually had Michael Kay and Alex Rodriguez. We called it K-Rod for Major League Baseball. We've done the UFC. I don't know, we did some golf. I don't know if there's another sport that we're super excited about, because we've kind of nailed it. If I had to pick one, it would probably be partnering with Gary Bettman and the NHL, because we have such a huge partnership with them that we just closed a couple of years ago. We got 6 years left on this deal. We're trying to grow the game of hockey, make the game of hockey younger, more diverse. There's an opportunity there.
Amazing. Jimmy Pitaro, chairman of ESPN and Sports Content, thank you so much for joining us today.
Thank you, Sarah. Thank you. Appreciate it.
Hello. Just quickly, so you all know kind of rest of run of show and rest of day. We have 2 more sessions, including the one we're about to do here. There'll be a break between this one and then Mark Cuban. Then there will be lunch, and during lunch there will be 2 pop-up conversations during lunch, one with the CEO of Neiman Marcus and one with the editor-in-chief of Chancery Daily. For anyone who's been following the Twitter Elon saga, you won't want to miss that. But now, I want to bring out Chris Sacca, founder, maybe CEO, I'm not sure, of Lower Carbon Capital. Chris. CEO, am I wrong?
I don't know. It's a pretty flat org. We don't have a lot of titles.
You don't have a lot of titles. So Chris, can I start here? So last year, you sent an investor letter. And for those who don't know, Lower Carbon Capital, as the name, is obviously focused on climate and climate tech. And the beginning of this 12-page letter said, quote, "The climate is fucked, even worse than it seems." 16 months later, even worse than it seemed then, More fucked, less fucked.
Yeah, I know. I mean, way worse. And so I think the models, even it's funny, even the people who are labeled alarmists now are calling it short. And so I think they didn't take into account methane, 82 times worse a greenhouse gas than carbon. And so we got a little bit of a reprieve thanks to the lockdowns and the slowdown in China, but it's bad. But I think what's worse is that it's exposed how climate just isn't hippie shit. It affects national security, it affects supply chains, it affects daily life. I mean, there's no line of business that will not be impacted by climate. That's also the opportunity, is there's nothing, there's literally no line of business. Nobody in here is in a business that won't have a massive opportunity as a result of what will be the biggest economic transformation in the history of the planet.
You started obviously you're a reformed lawyer, I guess you could say, and you were at Google for a while.
We can talk about that. Yeah.
Fair. And you start in venture capital as a kind of traditional venture capitalist, big hits, Instagram, Twitter, Uber, et cetera. You retire, you come back to do lower carbon. Was there a moment or a particular thing you remember that I have to do this? It's very different.
Yeah, I mean, okay, so lowercase was by necessity. I was still trying to, when you and I knew each other, I was paying back my student loans. A few years after that, I was still trying to get a mortgage.
Google didn't pay you enough to repay your student loans?
No, I finally made it back to zero after the Google IPO. And I had a party, but it was a BYOB party because I wasn't gonna go back into debt to host all my buddies. So lowercase is by necessity. It had to work. I didn't. In fact, when I wrote my first $25,000 check to Twitter, that was material to me. So I just would show up to the offices uninvited. Jack fucking hated me, but I was like, I need this money back someday, so we're gonna get to work here and actually build a business. And so I didn't have a badge to the door, but I did the first $35 million in revenue there because it just needed to happen. But lower carbon got to this point where, and no offense to my good buddy Mark, who's coming up in a bit, but I was sitting in this chair at Shark Tank, and somebody came in pitching a kitchen gadget. And it was cool. The entrepreneur was great. She was killing it.
Spatula
I could see the
3.0.
market. Yeah, exactly. I could see the market developing. And I just had this moment where I was like, is this why I want to, would I feel good explaining to my kids, this is why I can't hang out right now? It's because I'm working with this company. And because here's the thing, if I went on The Bachelor and got married and divorced 6 weeks later, that's par for the course, the tabloids would totally accept that. But when you do a deal with a company,
your wife might not, but continue.
Yeah, no, but if you do a deal with a company, that's like a 10 to 15 year commitment. It really is. And so, and I don't know any other way to be successful in that business than to dive in and really put that much energy in it. And it just started to feel empty for me. And my wife, Crystal, is my partner in all of this, and we just felt less fulfilled. It was also at the time that democracy was imploding, and we were really wrestling with a lot of stuff in the criminal justice system, the obesity epidemic, extreme poverty, and so we were pursuing solutions to a lot of that stuff. And it was starting to realize that in climate that we were wildly concerned about, it didn't have to be predicated on philanthropy and activism, that the unit economics of that business had changed. Because I think you can only, guilt and shame will only get you to change the behavior of 200 to 300 million people on the planet. Big number nominally, but relatively a small number. To get to the other 7.5 billion people, you have to hit them in their wallet. You just have to give them a better, faster, cheaper, cooler, sexier, more delicious, easier to use, more durable option. And I started to see that happen. The same thing that happened in Y Combinator was happening in climate tech. Massive compute clusters, synthetic biology tools that teams of 3 could get access to that would have cost $500 million just a few years earlier, to where they could build something that existed that you could play with, so it wasn't a business plan, and then they could get to that first arm's length customer in 12 months. And that was where it all shifted. And it was funny, when we first started it, big names in climate were like, dude, don't bring the torture on yourself.
Because the first kind of big VC wave in the climate tech, they all got wiped out.
Yeah, I mean, Dor will tell you, Dor's a mentor.
John Doerr,
Dor will tell you that his billion became 3 billion, and so just not in a hurry. And thankfully, he and Koso and those guys really did pioneer that stuff. But it was just too damn expensive. And so the cost to start those companies was too high. So the unit economics didn't make sense, and they depended upon regulation and subsidy. So when they started getting into climate, they also hired Al Gore and Colin Powell to go lobby. Well, I have an allergy to that political process. I mean, you can see I don't really dress the part, and I have trouble being diplomatic in those situations. And so instead, I wanted to build a business that didn't depend upon government for anything, where our relationship was directly between us and a consumer, us and a business, or us and government as a buyer. And not have to ask permission or beg, and instead just offer you something that you will choose because it's better.
I'm curious. There are some who agree with you about your statement that the climate is fucked, it's worse than you believe, and then they have an addendum, though, which is, and all the climate tech's being worked on, wonderful. We've already passed that Rubicon. It's nice, and it is good, and there might be money in it, but from a climate perspective, we're too late.
I mean, fuck them. I just don't have patience for that. What I would say is it's a J curve. It will get worse, but it will absolutely get better. And my job is to try and flatten out the trough of that J curve. And I'm really excited because I think the capability, I love when people hate on this because it's like those people who say we'll never need more than 7 computers in the world kind of thing, right? It's just like anyone betting against the pace of technological progress, I love being on the other side of that fucking bet. And so like what we're able to produce with costs coming down precipitously, with efficiency and productivity coming up, and what's happening on decarbonization, because it's just better. Like digging up and burning old dinosaur bones is fucking expensive. And so anytime we can take that out of a process, you make more money. We have a company that makes industrial scale chemicals using enzymes instead of oil. They do a 9-figure run rate right now.
What's the name of the company?
Solugen. 9-figure run rate, not sure if I'm supposed to say that, but 9-figure run rate, 60% margins, selling a commodity. And the people they sell it to are oil and gas companies who don't give a fuck about the climate. They ask 2 questions. Is it hydrogen peroxide? And is it cheaper? Well, then fuck it, I'll buy it. That's my dream customer right there.
One of the other things you said, and I don't know if it was in the letter you said to me, was that at the time you didn't feel, this is last year, that you were facing too much deal competition, certainly less than you faced when you were doing kind of traditional consumer tech or enterprise tech deals. Is that still true, or has the competition significantly increased for these deals over the last 16 months?
So this is the only time in my business where I have actively recruited other people to it. And by the way, after being locked in your house for a year and a half, there's a lot of VCs who are calling up and saying, hey, I want to move from success to impact. I want to get into climate stuff. It's not easy. We have a big science and technical bench. A lot of what we work on is hard. And so one area that's crowded is the SaaS stuff. There's going to be a ton of demand for SaaS. We've de-emphasized it in our fund because I don't think I'm really good at it. And there's a lot of VCs who are. And so we have a couple of companies in that portfolio, in that part of the portfolio, but we really don't seek those deals.
So, I mean, is part of what you're saying, you've got that there's a lot of VCs who want to be in the space in general, want to have the impact, but their core competency is still essentially software, not enzymes.
Yeah, I mean, we have a fusion fund. Someone coming out of a traditional VC fund is not going to be able to compete with us head-to-head for a fusion deal. And so with our science bench and understanding and our reputation. I mean, look, my secret formula for venture capital is have all the best companies in the world find you. Or know where to find them, have the acumen to be able to pick the very best of those, only get involved in the ones where you can personally make the outcome better, where you can improve the chances of success, and then make sure you own enough of those companies that it's worthwhile for you and your investors. And so I would not agree with our team to take outside capital until I was convinced we had the very best deal flow in the world. And the only way you get the best deal flow is to earn it, and it comes from other founders. It's the net promoter of your founders. I mean, it's great. You could take out a fucking ad in the paper. It's not going to matter. And so when we established that was when I knew, okay, we're leading this business. So we are right now.
With that, when you talk about co-investors on deals, there's a lot of fossil fuel companies. Look, Saudi Aramco today announced a $1.5 billion sustainable fund or sustainability fund, whatever the hell that means. They announced that today. What's your perspective on partnering on climate tech deals with fossil fuel companies?
Yeah, well, I'll probably get shot walking out of here, but fuck Prince Bonesaw. We're never doing business with those guys. So, but when it comes to the oil and gas companies, look, for decades, if you were an engineer and you worked in pharma, aerospace, automotive, those were the great jobs. If you wanted to raise a family and have a steady job, those are the great jobs. And so they're an incredible source of talent. And that's particularly the case for energy. A lot of what we're doing.
But I'm not talking about just recruiting somebody for your company. I'm saying
no, but what I'm getting
oil
to
company
is
X
that,
Ventures.
Yeah, what I'm getting to is that I can't shame the people who work in those companies. I can't shame those teams. I reserve some particular vitriol for the people who pretend that there isn't a fucking crisis and that it's not caused by humans and emission of carbon and carbon equivalents. But so fuck all those people. Fuck the GOP for continuing to propagate that bullshit. But the talent there and the people who are there to collaborate, they're incredible. I mean, our carbon removal stuff is running those same pipes in reverse. And by the way, that means the same leathernecks in the field, right? I mean, meeting with President Biden a couple years ago, he was asking about climate jobs, and he's like the Scranton, PA jobs guy, right? And I said, I want you to envision those Chevy Like a Rock ads. You know, like, you know, they would play Like a Rock, you know, those truck ads during the Super Bowl.
We have time. Do you want to do the whole song?
I got it, man. You guys cue that up for me? But like, it's the same truck, same mud, same sparks, same hard hat guy wiping his brow, trusty dog, American flag beer at the end of the day. That's what it looks like when you put up a windmill. That's what it looks like when you are actually sequestering carbon. It is the same fucking job. And there are more of those jobs in Texas right now than there are in oil and gas. And so we have actually found, you know, like Halliburton reached out recently and asked to invest in our fund. That's not going to happen. But what I said was, why don't we get our labs together? Right? And they were like, great. And I was like, look, I am not going to be sanctimonious about getting our actual engineers together and working on stuff because they've got a ton of resources. And if I can, my goal is to co-opt them because it's just a better business. Like we've seen what happened in solar. The first stuff was like green premium. Yeah. Now you've got groups like D.E. Shaw, that's one of the largest solar operators in the world. Those guys just print money, and I don't think it's political, and they're not just trying to be nice about it. They just know where the money is.
So speaking of political, we were talking about this backstage. You haven't made a political donation in a couple years from now. Leaving aside the fuck the people in GOP comment from a minute ago, how do you actually? Let me ask two things. Which is first, why haven't you made a political donation in a couple of years? You were pretty prolific.
Yeah, I mean, we took on rebuilding the Democratic tech stack after 2016. It was just crazy that it didn't exist, and the party would have to rebuild it every year. And so with each campaign, it would die, and you'd have to start again. So like the Hillary campaign didn't have anything we built in the Obama campaign. It's ridiculous. So with the leadership of our partner Clay Dumas and a bunch of other folks, we collaborated to try and build that stack so it actually survives every election cycle. Build those as for-profit companies with stock options, engineers who work there full-time, and it works. I mean, I know we won Georgia, and so I can point to the votes we delivered there. That shit's exhausting, and politics is tough for a couple reasons. One is, I mean, the people you elect are always striving to almost meet your expectations. But it's always so many degrees removed from the solution too. Like, we're trying to build stuff to convince people to maybe get off their asses, to maybe go pull the trigger, to send somebody there who's gonna be locked in gridlock. And so I just don't have that patience. Like, particularly when we're thinking about a truly, the word existential is used a lot, but this.
But how do you get viewed? You know, when you're meeting, and particularly given where a lot of the companies you invest in are based in red states. You obviously have companies on the coast, but you have a lot that are in the middle and in the Southwest. I assume you sit and meet either at the local, the state, or even the federal level with Republican politicians. Yeah. How do you have those conversations, given where your politics are coming from? And they know where your politics are coming from.
Because we never talk about it. So that's number one. First of all, I'll roll up my F-350 if it helps bridge something there, and we'll spend the first 15 minutes talking about our ranches. And, you know, it's easy to dismiss cattle ranchers and farmers, but, and they may have a Trump flag flying in their yard, most of them do, but the reality is they're stewards of the land, and often for generations. And so we look for common ground there. And if you're talking to the governor of Wyoming, I live in Wyoming, the largest coal-producing state in the nation. You're talking to the governor of Wyoming, he knows that that state is facing a real threat. As Trump did everything he could to deregulate the coal economy, it doesn't work. The economics don't work. And so if you cast all that shit aside, remember that Wyoming is a state that literally kicked Liz Cheney out of the party. It's weird to pull a lever and vote for Liz Cheney. I'm still traumatized. But when you have that conversation, just talk about the sheer economic interest for a state or for a business, the job creation, the revenues that come from that, the stability of that for a local economy. It's a totally different conversation. When you sit down with folks in West Texas, they got trophy hunted animals in the background behind them in the meeting. And we do have one elk that was in the house when we bought it, so I made sure it was in the back of the...
A full elk?
No,
or
it's
just
like
the
a
head?
bust of an elk.
Okay, just checking.
So I made sure it was in the back of the Zoom. But when you sit down and talk to those guys, you talk about daily life there. It's hotter than shit, unbearably so. Yields are down on the ranches. Cattle are struggling. The aquifer is totally fucking depleted. And they have daily seismic activity as a result of fracking. Earthquakes every day. So you talk about that shit, and then you talk about the green jobs that result from the kind of stuff we're doing, and it is a completely different conversation.
Within climate tech, give me one subsector right now that you think is overhyped.
Hydrogen.
Why?
So it was such a buzzword that a lot of money went into it, and I think valuations are out of control there. We have some bets there, and we think are better than everybody else's. Obviously, I'm a competitive person at heart, and I have no allergy to winning. But I think hydrogen gets a little bit too much press, and I also think there's too much focus on direct air capture for carbon sequester, and they kind of throw the entire sector under the bus because of DAC. You know, the first direct air capture projects, they probably used up more carbon flying to the, emitted more carbon flying to the ribbon cutting than they did, than it'll ever take out of the air. But they were really important demonstration projects. Direct air capture will be a big part of carbon removal, but a bigger part is going to be kelp, or macroalgae as it's called. A huge part is going to be basalt and limestone and mineralization, algae. Accelerating natural processes are going to be a big deal.
And this is going to be, I'm going to now display my ignorance when it comes to this stuff. You, when I say you and lower carbon, have invested in carbon capture. Where have you focused your, and help me understand the distinctions here.
Well, we launched a broad decarbonization fund. I mean, now we're on, I think we have 6 funds. And I'm not going to talk about future plans because the SEC still has these rules from 1933.
Like Chamath, he also is about to be raising money. He can't talk about it, but I'll tell you, he's going to be raising money, so I'm told.
I just blacked out for a second there. Literally, those laws date to like 33, right?
And did you know, and I can say this as a reporter doing this forever, no one's ever been penalized for violating them, ever. So you want to talk about it?
Do you guys know about SPACs, by the way? Should we? I missed that talk. I don't regret it. But we started with some broad decarbonization funds. And I can't believe I'm going to do this considering Chamath was up here earlier, but I am going to use a poker analogy. When the pot odds change, we push in more chips. And so carbon removal was part of our strategy, but we started to see that our market was really developing. Between the advanced market commitment coming from Frontier, which is $925 million committed to buy it, some countries, some trade bodies like the airlines. But what we really saw that was nuts was when Stripe and Shopify each launched a checkbox for merchants that said, do you want to dedicate 1% of your revenue to carbon removal? 8.5% of merchants said yes. Broad-based, non-billionaire philanthropist people saying, hell yeah, this matters to me. Tens of thousands of individual business people with compressed margins doing that. That was a sea change, and so we unfortunately stole the guy from Stripe who was running it and had him come over and work for us. It was a little uncomfortable calling Patrick and John. They sighed and then said, all right, how can we get involved? So they're big partners in that work. We did the same in Fusion. Fusion, people have said it's decades off for decades. Anyone who says that now hasn't been in the lab. Thanks to machine learning, experiments that used to take 1 to 2 years for one experiment now happen thousands of times per week in high fidelity in the computer, and they can try the crazy shit that never would have made it through the risk community. And so that development is straight up, and my partner is usually the one who hits the mute button on me, but I'm not going to preempt anyone's announcements. I can say Fusion is happening every single day, and now it's about net energy created, and I'm not going to spill beans.
I'm just going to follow up on that with you later, after. You raised Chamath. Let me suggest or say something he mentioned actually on his podcast last week, which I listened to. Was going to ask him about, but I'll ask you about. His perspective on IRA, among other things, was that he thinks it kills the prospect of there really being actual carbon trading. He thinks that IRA kind of. Do you not agree about IRA, but do you think there is going to be actual carbon? It's been talked about forever. It hasn't come to pass.
I mean, carbon trading is supposed to have that bipartisan support, but there is no bipartisanship anymore. And so we just can't wait on that. I mean, it's funny, when the IRA was passed, people asked, did you guys write it? And I was like, I didn't even go to the ceremony celebrating it. We had nothing to do with it. However, if there is free money falling out of the sky, I will be there with a bucket to catch it.
How important, and I'll just ask this generically, how important to lower carbon and to its funds, to your returns is the IRA?
Yeah, I mean, President Biden himself called it a big fucking deal. I mean, those were his words. Like, I will double up on that. It's huge. I mean, we had a company last week that just got $50 million of grant money from that. It is massive. And it is driven not just by the climate implications, but by the business and by, we are, for better or worse, and I would call myself a globalist, but we are headed towards a much more polarized world right now. And we are absolutely dependent upon other countries for our supply chains. And so we need to rehome within the West the entire electrification and battery supply chain. It's just been neglected. And of the 9 steps you need to make a battery, 7 of them are not within the West at all. And so I have actually been wildly impressed by the folks working in the government who are directing this money towards the places that can help. But look, we just, when we met with investors recently, we were like, hey, look, it turns out we were right, but we were even righter than we thought. And I say it with humility because it's super fucked up to think that your business has been accelerated by a war in Ukraine, but it has. And we are learning that our addiction to suicide fuels is literally killing us, and it is subjecting us to the whim of these petrofascists. And so we've been sitting here doing keg stands, sucking down barrels of Brent crude and neglecting transforming the entire economy. But now I've got guys from the military, I've got guys from the other side of the aisle who just realize, I sat with the vice president of the EU a couple weeks ago, Timmermans, really smart guy, and he leads their green stuff. And he said, this winter, they've got like 85 to 90% of their energy reserves, gas coming down low, they're able to accelerate banking, some of that stuff, but next winter will be a human crisis in Europe. Fucking Europe, right? I mean, those are the stakes right now.
How important, you're obviously in the private capital space, when you watch any of these climate conferences, et cetera, when regulators, governments, et cetera, they've most recently been talking so much about how to, quote, solve this. The private capital is going to be, they kind of put the onus on private capital. Private capital sometimes in response puts some of the onus on government. IRA obviously comes through. Are the regulators right? Is private capital the key here?
It was an ignored key for a long time, and it's a big part. I mean, look, I think personally the most inspiring figure in this entire movement for me right now is Secretary Kerry. And so the climate envoy for the United States. Like, that guy could be with his feet up anywhere right now. And he is absolutely served. I mean, from the military on through Congress, that guy has served and done everything he can. But
what's he practically doing?
He's practically on the road 300 days out of the year going not just nation to nation and getting them to make commitments. I mean, he just secured 4 more countries this week on methane commitments, which are huge. But he's going big company to big company. I've been in the room with him with some of the biggest polluters in the world and watched him secure commitments out of them. And by the way, some of those commitments aren't just like, hey, we promise to decarbonize. Some of the most important things he's done are these advanced market commitments. So, we work with the largest steel producers in the world, some of whom are LPs. And we just say, look, all I really want from you is just commit that if we deliver you steel of X, Y, and Z parameters, you'll buy it. And so, I don't actually need you to make a trade-off. Because here's the unfair thing about our business. Somebody asked me, I didn't even kind of process this until recently. Somebody asked me, how do you guys achieve product market fit? Because, you could work on Twitter for 2 years, very cool app. And in our old portfolio, we had 2 things we had Dub Smash and Triller, which are TikTok. They didn't work. There's no reason they didn't work, right? They just didn't become TikTok.
There were some reasons Triller didn't work.
Sure. I mean, and it was an old partner of ours who was underwhelming who did those deals. Fuck it. But you could build Twitter for a couple years and put it up in the App Store and nobody gives a shit, right? Because you're trying to create a new user behavior, trying to look in the crystal ball and predict stuff. Everything we build at lower carbon is a substitute good. Like, it's wild. I know the exact demand for everything out there. I mean, we have a partner who came from TPG and Bain, and I never would have hired somebody like that at lowercase because I don't need a model to do the Twilio C deal.
Yeah.
Right now, I know exactly what the demand curve is, and I can call the customer and be like, will you buy this shit? Hey, by the way, will you commit to buy it today? So Hart Aerospace, our company makes electric airplanes out of Sweden. By the way, again, a beneficiary of machine learning, they built the plane in the computer before they assembled it in the hangar. And so they took a 11-year, multi-billion-dollar process, and on single-digit millions of dollars, they built it in 2 years. Along the way, they figured out they could make it 30 seats instead of 19 seats. So they've got billions of dollars of orders from the majors, not because they're trying to be warm and fuzzy, but because those planes make their unprofitable routes profitable. And the result is it's just good fucking greed-driven business.
Final question for you, very quickly. You started this by saying that you were on Shark Tank when you kind of decided to do this. Mark Cuban comes up after the break. What's one question Hope should ask him?
So here was my big mistake on Shark Tank. is that I fucked with Cuban a lot because that's the nature of our friendship. But he's a religious figure in the United States. I realized, like, Mark Cuban could be president if his family decided they were on board for that. There's no doubt. That guy, I have walked through the parking lot of an SEC football game and just watched the C's part, and I would get stepped on. Nobody even noticed I was there. In fact, I literally changed out of my Shark Tank clothes into clothes for the game while standing next to the Bo Jackson statue, the meeting spot. I literally stripped down to my skivvies. Nobody fucking noticed because Mark Cuban was standing next to me. So I have learned not to fuck with that guy ever again. So I actually deeply respect him. I love to tease him and challenge each other's thinking, but honestly, I think he's one of the most authentic people. And by the way, I owe him no money or anything like that. So I'll just say straight up, I think he's a reader. I think he learns. I think he's humble. And, you know, a guy, unlike some other people who showed up today, rolls in with no security, and it's just who he is. And so I wish I could bust his balls right now, but I'm really grateful for what he's doing on the drug stuff. I think it's really important. So
we'll do that after break. Chris, thank you very
Thank you,
much.
everybody.
Appreciate
it.
All right. Thanks,
here for, so you got to give me something. Thank you. Hello again, everyone. We're so happy that all of you are here to really witness our inaugural BFD. We want to thank you again for being here. My next guest, as David Letterman says, needs no introduction, and apparently he's been called a religious figure in the U.S. So please welcome to the stage none other than Mark Cuban. All right. You have a new title.
Yeah, don't ever say that again.
That's Chris, not me, I think, right?
That's just wrong. I love Chris, but that's wrong.
Well, what's not wrong, you're the co-founder now of Cost Plus Drugs. It's the first company you put your name on. You said this is the thing that you are most proud of. Why?
You know, costplusdrugs.com, if you haven't heard of it, if you go there and put in the name of a medication you take, the first thing you're going to see is our cost. And so for those of you who take generic Cialis, not that anybody has to, but for those of you who do, you'll put it in there and you'll see that it cost us 4 or 5 cents a tablet. And so then what we do is we mark it up 15%. Because it's mail order initially, we add $3 pharmacy fee and $5 for shipping. And now you know what your medications cost and why. And with that transparency, we've been able to cut pricing for a list of more than 1,000 generics by as much as 99%. And I put my name on it because what we're really selling is not medications, what we're selling is trust. And I wanted people to know that with all the distortions in healthcare, with all the lack of trust in the entire healthcare system, except for maybe your doctor, that by putting my name on it, you're going to get a financial commitment, an emotional commitment, and a transparency commitment. And the response has just been insane. We just launched January 19th, and we're at 1.2 million accounts already. So it's crazy.
You're on track to be profitable by early next year. Is that still?
Yeah, give or take. I'm not so concerned about when we're going to be profitable. I'm more concerned about the impact.
What about the scale? Because right now, generics, but you need to bring down the other costs.
Right. So there's generics and there's branded. Branded's a little bit more complicated because the way the pharmaceutical industry, the way the PBMs work, the pharmacy benefit managers work, it's really become distorted. But we added our first with Roche, who came on as our first branded source, and then we'll be adding more week after week after week. So we're at 1,000 plus generics, high-priced generics. I'll give you another example. I mean, to show you just how fucked up, you're welcome, Chris, how fucked up this industry is. 2 examples. One, a couple weeks ago, I got an email from a mutual friend of a guy named Landon Turner. And Landon played basketball at Indiana University when I was there, and unfortunately was in a horrific wreck that left him paralyzed. And his insurance changed, and he had to take this drug, droxidopa. And it turns out that when he went to go get his prescription, they were going to charge him $30,000 for 3 months. And Mark, can you help me? Well, it turns out it was generic, not readily prescribed, but generic. We got that cost down to $75 for 3 months. And 2 days ago, we got the same type of email from somebody who was in a panic. Her child has got sickle cell anemia. I forget the name of the drug, and she was being asked to pay $2,000 a month, and she couldn't afford it. We got that down to $70. And think about your own personal experiences with medications. Your doctor says, okay, you need to take XYZ drug. What's the next thing they say? What's your pharmacy? What pharmacy do you use? It's not, what kind of insurance do you have? It's not, this is what it's going to cost. Can you afford? What's your pharmacy? Then you go to the pharmacy, and the pharmacy doesn't even know what they're going to charge you, right? Mm-hmm. They just look up, oh, Mark Cuban, I take Synthroid for thyroid. Okay, this is, and they just, what's your insurance? And here's your copay. And that's it. Nobody really participates in the entire process. And it's so opaque. When we came in and added transparency, it just changed everything.
You're being very polite on stage, but you've talked about them as sort of the bouncers. They hold the velvet rope to the cost. If they were to have come on Shark Tank initially, would that still have been a good business model? Would you have invested in the PBM model?
I would have fucked them up.
Would you?
You're welcome, Chris.
That's 2. Yeah. But you're now partnering with some of them, and you're trying to also
Well,
emulate.
no, not the PBM. So there's 3 big companies that just dominate, and they're full stack, to use some technology, some tech, where it's a big insurance company. They also own a pharmacy benefit manager. They also own retail pharmacies. And then they're buying more and more and more things. And so they play this left pocket, right pocket game with manufacturers and patients. And so the PBM will go to the manufacturer of a drug. And honestly, as much as we are being taught to hate manufacturers of medications, they're demonized. They're not really the bad guys in this whole picture. So the pharmacy benefit managers go to the manufacturers kind of as the door person, and they say, look, I'm doing the negotiating for this big insurance company that owns me, plus all these other insurance companies, plus a bunch of huge self-insured companies, and so I want to negotiate a price from you. And they say, okay, we'll give you a great price. Then they go back and they say, you know what? Now that we've negotiated this price, when I help a sale close and we get it into one of our pharmacies, I need you to rebate me back more on top of that. And so, but then they're not done, right? And they're like, oh, by the way, because the rebates are a percentage of, let's just call it retail price, I need you to set the retail price as high as possible. Because when I go to the government, I want to be able to, don't tell anybody, say to the government, I want to give them 40 or 50 or 60% off, which is 60% off of a made up number, which creates a super high price that Medicare or whoever pays, right? And so you end up with all this distortion, and because they own this vertical stack, it's so opaque, nobody really knows what the pricing is. And because we're transparent, this group out of Harvard, because we were the first to truly show our costs, just took 70 of our medications, this was 6 months ago, and looked at what Medicare spent on those 70 medications. And we now sell over 1,000. Just in those 70 medications, they said if Medicare would have negotiated and just used our off-the-shelf prices, they would have saved $3.6 billion a year. That just shows you how crazy this whole industry is.
What's your pitch to the manufacturers?
There's a bunch of pitches to manufacturers. One, you don't have to pay rebates, which means the net price is delivered to the patient, which means your product is delivered to the patients who need it for far less. We're working on insulin. We're close. We're not there yet, but we're working on insulin. And with insulin, it is just so back-ass half-word the way it's priced that the rebates just distort everything. So we work everything on the brands. We'll say to the brands, look, the net price goes right to the patient. Mm-hmm. The net price goes right to the corporation, if it's a self-insured company. Whoever, it's always the net price.
But it's based on scale too, right? You're pitching them, eventually you'll have the scale.
Yeah, it's not even about scale really, because there's so many, the pharmacy benefit managers have their hands in the manufacturer's pocket, every pocket, every crevice, between their toes they're extracting money. They just take money from the manufacturers every chance they get, and we say no, right? Because if you think about insulin, when people come up to me and talk costplusdrugs.com, when are you going to get insulin? Because everybody just presumes insulin is the most distorted pricing of everything because it's so expensive for so many people. And the administration, and it was a great deal, $35 cap starting in 2 years, et cetera. Well, the price of insulin from the manufacturer, the net price from the manufacturer to these pharmacy benefit managers has gone down every single year. But none of that savings has been passed on to the patient. And so those are the types of things we're trying to resolve.
You're also trying to manufacture. There's a lot of work to also be done by pharmacists, which is pretty manual. How do you plan to scale that?
Well, on the manufacturing side, we'll start with injectables. Believe it or not, in 2022 in the United States of America, there are a lot of medications that go in short supply. And when there's not a big enough market and it goes in short supply, what do you think happens to the price? So we created we're in the process of finishing up our plant for injectables in Dallas, Texas, and it's designed using robotics, so it takes us 4 hours to switch over product lines so that where there's a shortage of sterile water, boom, we can do it. When there's a shortage of oxytocin, boom, 4 hours we can create whatever it is and solve the shortage.
And then when it comes to actually accepting insurance, any timeline on that?
Yeah, we already started. So
okay.
we started working with Capital Insurance, which is a Blue Cross Blue Shield out of Harrisburg and does all of Pennsylvania and nationally. Actually, we're adding more and more because what's happening with insurance companies is, remember, when you use your insurance, the PBM then goes to the insurance company and says, here's what you have to pay us when Mark picked up their Synthroid or the Voxer, whatever. And that price is based off of the inflated retail price. So your insurance company is paying an inflated price for the drug you use. Now, if it's one of the big three who owns that PBM, it's just left pocket, right pocket. But for any other insurance company, like a Blue Cross Blue Shield and others, it's just increasing premiums and costs for patients. So we're working with more and more of those.
Right, this was just announced and it'll be
Right.
effective next year. Really quickly on TruePill, this startup has started to, 4 rounds of layoffs now, and you've been using them to actually fill and deliver prescriptions. How does that actually impact your business?
Yeah, I mean, we're fine. They've just got more funding, and so we'll be fine there. They do our software and do a lot of our support for us and do our pharmacy for us. Sid there does a great job, and so, working with Annie Lamont, one of their investors, and their team has been great.
There's been a lot of consolidation. I think you told Kara Swisher at Code that Amazon's margins are your opportunities.
That's right.
Say more about that.
So, I mean, I had to tell Bezos, your margin for your pharmacy business, your margin is my opportunity, and I mean that because they have a big organization to run. We're focused on one thing, being the low-cost, trusted provider for every medication we're legally able to sell. You're not going to see telehealth on costplusdrugs.com. You're not going to see blogs. You're not going to see content. You're not going to see videos. When we say we are lean and mean, we truly mean it because, again, when people have to make a choice between food, rent, and medication, that's just wrong. And we could put in bells and whistles, but if you never know what that inflection point for any one individual or family is. That $1, that $5, that $10 that I might invest in having a world-renowned doctor talk about X, Y, or Z might be the amount of money that this person or family can't afford and prevents them from buying from us. And so, we're not going to have hey, we're the our NPS score is 99. That's not us, right? You're going to get a little slower response, but you're going to get a lot cheaper medication.
What's more opaque, the Facebook algorithm or how actual rebates work?
Rebates. Yeah. It's not even close. You can almost reverse engineer algorithms, but, and kind of understand, but the rebates are intentionally distorted. The whole pharmacy industry is intentionally distorted, and that's why we're trying to turn it upside down. I mean, look, we haven't even talked about independent pharmacies. It's crazy. I'll give you a sense of the craziness for independent pharmacies. Independent pharmacies, there's so many acronyms in the pharmaceutical industry, I don't even know them all. But they pay, let's just say, their wholesale price. And that wholesale price is only 2.5% less than the set retail price. But in a lot of cases, their insurance remuneration for that same thing that they just paid a 2.5% discount versus retail, the remuneration is 10, 15, 20% less than retail. So they lose money on every single prescription that they fill. And that's because of the pharmacy benefit managers. It wasn't like that 15 years ago. It's like that now. And on top of that, they charge the independent pharmacies to send them business. So a lot of the coupon programs, and we're getting ready to set up our own coupon program that'll pay the independent pharmacies to help keep them in business so they make money when someone goes to uses a Cost Plus Drugs pricing with them. They have to pay money to get the traffic from these discount cards, which is insane.
Do you think the U.S. government needs to step in?
No, it's just you've got one industry that's fucked up, right? And you've got 3 players that fuck it up, right? And now it's my turn to fuck them up. You're welcome, Chris.
No, I like that a lot. So lastly, I think you have pledged to Trevor Noah.
I'll drop a few more F-bombs if you guys want. This industry is just ripe for it.
You have pledged on Trevor Noah that you would never raise prices.
Well, it's not that we would never raise prices, right? What I said was we will pass through all of the price cuts that we get, but if our cost goes up, then the price, but it'll always be the same formula. Our cost plus 15% plus shipping and handling.
And not to be morbid, but a succession plan, I mean, how do we ensure that that happens even when you're not at the helm?
I mean, my partner, Dr. Oshmayansky, is amazing. I mean, this whole company does not happen. I mean, I learned long ago to partner with people a lot smarter than I am. And this guy is truly, I mean, he's a PhD mathematician, he's a radiologist, and, he's insane. And he's only 38, so this will be around for a long time.
All right, let's switch gears, talk about a deal that is set to close on Friday, the Twitter deal.
Okay, before we go there, let me
Okay.
just say again, let me do my Shark Tank sales pitch. If you have any medications, go to costplusdrugs.com and look them up. If you are a startup looking to raise money, one of the most hidden sources of latent capital is in your generic medications. I'll give you a quick example with the Mavericks. I had our HR person go and take only generics that cost more than $30 and look at what we paid for those generics over the last 2 years. The Mavs spent $165,000. Then I had her look for the Cost Plus Drugs equivalent, $19,000. And that's only with a couple hundred employees. And so if you have 200, 300, 400, 500, 1,000, 2,000, if you're self-insured in particular, if you're renegotiating your insurance program, go to costplusdrugs.com, look up the prices, email us there, we'll send you a price list, and use that as a way to go back to your insurance company or go back to however you're sourcing medications for your employees and reprice them. Because that's immediate cash for you, for any one of your businesses. And people don't realize it, but particularly now when it's hard to raise capital, if you're already operating, it's the best way to raise capital.
You should check your traffic numbers after our
Right,
conversation.
costplusdrugs.com.
There you go.
Okay, what were you asking?
Twitter.com or the app. Are you friends with Musk? And do you talk to him about this?
Not really, no.
What do you think is going to happen after?
Don't care.
You are on TikTok. You said it's the best way to keep track of your kids.
Yeah, that's, so those of you with kids, particularly teenagers, mine are 13, 16, and 19. The best way to know what they're into. Like when I was a kid, my dad would look underneath the mattress to see if there was a Playboy or two, or when I was younger, National Geographic, right? You gotta be really old to get that one. But now, my 13-year-old son, my 16-year-old daughter, give me your phone, and you just scroll through TikTok. And because of that algorithm, you know exactly what they're into. And they can't hide it. It's not about who they follow. It's not like, oh, look, I follow this person. I'm sweet. I'm nice. This is really what I like. No. That algorithm, it comes fast and furious, and you know exactly what they're into. So while there's a ton of shit wrong with TikTok, that's one thank you, TikTok.
Okay. All right. Well, about social media in general, I mean, it is really a big driver of divisiveness.
Yes.
How would you fix it, especially because you want transparency?
It's a symptom. Yeah, it's a symptom. It's not the problem.
Okay.
Right? I mean, the devices, if I had to say, okay, Mark, your chance, one thing to do, it's our political system, right? A two-party system is fucked up. And so if I had to fix it, I'd do what the city of New York did. I'd go to ranked choice voting. And I think, people in power from both parties are against it. Florida passed a law saying you can't do it in Florida because they're trying to retain power. And it was, probably the only thing that was bipartisan in Florida in the last 5 years. With ranked choice voting, you have a chance to have better candidates. If you think about, when you talk about divisiveness, think about primaries, right? So few people vote in primaries that the people who do vote are the ones with the most extreme views. And so the politicians have to pander. So you saw people who initially were, just so anti-abortion, it's the worst thing ever, and then once they win their primary, then they take it off their website, right? Because that's how primaries work. And the people who fund primaries are the most extreme because they know they have the most impact. Ranked choice voting, that doesn't happen.
You're not running.
No.
And you've talked about this in the past with respect to protecting your kids.
Yeah.
Even if they grow older, this is off the table.
I can do more here because the system's so messed up. I'd rather fight. I can have a bigger impact. Well, first of all, with pharmacy, obviously, I think I can have a huge impact. We're saving lives, we're changing lives, and there's nothing more gratifying than that. But then, if there was a plan B, it would be to push ranked choice voting or open primaries, et cetera, because that's how you're going to at least start to reduce some of the divisiveness. Because, some people want to, be logical and say, this is why I'm on this team, and other people just want to say, well, everybody hates me, so that's why I hate them. And that's their excuse for their team. And it's just because that's the way the system is set up.
Republican lawmakers are going after woke capitalism, ESG, Texas, Florida. How does this
They don't give a shit about any of that. Really. If you go down the list and then you talk to them, because that's what works. And why does it work? Because in the system that we have, you have to pander to the extremes because you have to get through the primary. You have to get that money. Do you think that the two parties pick the best possible candidates? So does anybody here think we get the best possible candidates with the two-party system? Raise your hand if you think these candidates are always the best.
Wow, nobody. Just for
Yeah,
those watching the live
it's
stream.
insane, right? The system is broken, and these are the symptoms of a broken system.
So how do you advise companies who are looking at the backlash to,
It
are they going to
disappears.
stay?
So, okay, so 2 years, during the pandemic when we didn't have any fans at the Mavericks games, I just wanted to see if anybody cared, so I said, don't play the national anthem. All right? There was no fans there. There was like 900 people, other, administrative, league, etc. Nobody noticed. Do it again. I want to see if anybody knows. Nobody. I got to the point where I forgot we weren't playing the national anthem. And then one media person noticed, and it was a huge deal, right? And so the state of Texas passed a law saying that if you take any state funding, you have to play the national anthem before a sporting event. Well, one, we don't take any state funding, so it didn't apply to us. But two, no one's mentioned it since. Nobody cares. It's the ultimate virtue signaling that every politician does all the time. So when they talk about ESG and when you're woke capitalism, we're passing this rule, it's all nonsense, right? And it's just there to signal to their potential voters that I'm playing the game.
One thing you predicted, just switch years again, you said that the NFL would implode within 10 years. That was about 10 years ago.
Yeah, I was wrong.
Greed has worked in the NFL's favor. Why do you think that is?
I mean, just the way things played out. I mean, back then, where the underpinning of where I was wrong is I thought that linear television would stay stronger longer. I knew that streaming would happen. Obviously, I mean, I made my money from streaming, but I thought that linear television would be in a better position over the next 10 years, and that just trying to take over every night of television was really, I have one of my corny sayings is pigs get fat, hogs get slaughtered. When you try to do too much or try to get too greedy, then it typically backfires. But gambling, I think, was really the linchpin that changed it for everybody, and streaming changed it for everybody.
And in terms of media rights for the NBA, Apple or Amazon?
I don't care.
You don't care?
I mean, because streaming, everybody has pretty much the same technology, same latency issues.
I mean, as a pioneer of streaming, is there something you would come in and fix at this point? I mean, it's the scattered nature of
if I was going to do anything differently, I would have a lot more streams, right? Because for a long time, linear television was bandwidth constrained. They're not between compression and bandwidth availability, you're not bandwidth constrained. So you're starting to see, the Manning stream, et cetera, but there's no limit to the number that you can create and deliver. So I would do more of it.
All right, let's talk just big picture now. How worried are you about the economy going to a deeper contraction?
I don't know. I mean, am I worried? Everything's on my mind. Can I predict what's going to happen? No, I don't know. There's always so many, context matters, right? And there's always something new that changes all the variables, right? It changes the interplay between all the variables. Ukraine, inflation, all these different things, right? Everything. And so I don't try to predict. And I'm an investor in 200 plus businesses, Cost Plus, other Mavericks, other businesses I'm actively involved in. Where there's uncertainty, you just have to communicate more. You have to communicate with your partners more. You have to communicate with your customers more. You have to communicate with your employees more. And just be honest. I mean, if there's anything we learned on the business side from the pandemic, is communication is a value add and it's a differentiator. Everybody's afraid. Everybody's uncertain. Anybody who tells you they know what's going to happen is lying, right? And when there's uncertainty, there's opportunity to communicate. And I think, the companies that communicate best to their employees and stakeholders, that's how you come out the best, because that's where you get the best information and that's where you retain the best relationships.
Speaking of employees, there's been a lot of talk about quiet quitting, that there's a 4-day work week movement happening. Mr. Wonderful hates the idea of quiet quitting. How do you manage employees that are feeling a bit overwhelmed?
Everybody in the universe that's ever had more than 3 jobs is quiet quit. I can't tell you how many times I came into work hungover when after college. Came in working the same suit, that's about the definition of quiet quitting, People have lives, and different people have different missions. And the goal of a company is to know as a leader, how to match up the ambitions for the corporations to the ambitions of the individual, the employees working for you. You have to start thinking bottom up, not top down. because, you know, I always tell our folks, like, there's different types of employees. You know, the primary differentiator, there's those who reduce stress and those who create stress. And you want those who reduce, obviously. But some people, if you tell them A, B, and C, they do A, B, and C, right? That's it. And they're going to go home, hit 5 o'clock, and at 3:30, you know, they're going to the bathroom, trying to kill time. They're working backwards. They have 90 minutes to kill, you know. And if they're remote working, if you communicate and you create a good culture and you set goals and you make sure that as well as you possibly can, you align those goals with your employees, you're going to be okay, right? If you try to get into the nomenclature, quiet quitting, do I have any quiet quitters?
Mm-hmm. Yeah.
Are you a quiet quitter? You'll spend so much time looking for the quiet quitters, you won't have it, you won't get anything done.
So, I mean, because the concern has been, well, there aren't enough hustlers then to build businesses, to build startups.
Bullshit. You know, look, I think Gen Z is
Coming from a hustler saying this?
Yeah, oh yeah. I mean, look, I'm on Shark Tank, right? Friday nights on ABC, 8 p.m. Eastern, 7 p.m. Central. I'm a hustler. The reason I do the show is because kids watch it with their parents. You know, kids come up to me, oh, you know, I started this business because I watched Shark Tank, or I understand business. And now they're coming back on Shark Tank. You know, we're in season 14, Friday nights on ABC. And they're like, we started watching you when I was a kid and I started the business. There is no shortage of entrepreneurs. We're a nation of entrepreneurs. That's what makes this country different than pretty much every other country in the world. There is an American dream and it is alive, and that's why I do Shark Tank. Not everybody's going to be an entrepreneur, but there's no shortage of them. And Gen Z, they have so many tools available to them. You know, there's so many ways to innovate now that everybody's got an idea for a business. There's not one person in this country, at least, that hasn't had that feeling in their stomach. Oh, I got this idea, right? But now you can just go online and look to see, has it been done before, or whatever. You know, email your friends, post it on social media, and get feedback. It's so much easier to be an entrepreneur now than it's ever been. And so the whole idea that, you know, no, that's all fucked up. No, that's bullshit.
Okay, well, and they can also email you, apparently. You actually have...
Yeah, we don't need to give my email out
again.
again.
Okay, not today, but I got to get these last two in. I know we have to wrap soon, but what more can be done to help women and underrepresented communities who were disproportionately impacted by the pandemic?
You have to invest there. I mean, I love invested with underrepresented entrepreneurs and underrepresented communities because it's hard. People inside a community are always best enabled to sell to that community because they understand it, they're connected, there's relationships. And so when you want to find new opportunities, I mean, go look where others are not investing. You don't want to, I try not to look where everybody else is. You know, if 1,000 people, I don't want to be 1,001. I try to look where nobody is. And there aren't a lot of people in underrepresented communities. And by going there, you're going to find people that may need a little bit more help, but they have access to people and places and communities that no one else is selling to.
We started the conversation talking about Cost Plus Drugs. It's the business that you're most proud of. What would you say your kids are most proud of you?
Their allowance. You know, it's an interesting question. They're teenagers. You know, their whole mission in life is to roll their eyes at me. And
so there's nothing that you do that impresses them?
No. They're teenagers. I'm just dad, you know, and so, yeah, it kind of drives me crazy sometimes. But don't you, I remember, like, I was like, oh my God, we just saved this person, da-da-da, with Cost Plus Drugs. Yeah, we know, Dad. Great, congratulations. What's for dinner? You know? So
people coming up to you on the street and hugging you and thanking you, it doesn't do it for them?
They're teenagers.
They're on TikTok. Mark Cuban, it's been such a pleasure and privilege and honor. Thank you so much.
Thank you. Appreciate it.
Thank you all for tuning in to the live stream. We are going to continue the conversation here in person, so stay seated for just a moment. But thank you all again for tuning on the live stream. And just a few final thoughts from our senior editor of Axios Pro, George Moriarty, next. Thank you.
Thank you.